ready to start now. So to start this morning's event, can we please rise to our feet as we take the national anthem? Okay, so we'll just stand at attention while the national anthem plays. Thank you. All right, thank you very much. Please take your seats. Good morning once again. I'd like to welcome us all to this event this morning. This event being the Valuation Seminar, organized by Dear Fatimile & Co. in partnership with Business Day and the Royal Institution of Chartered Surveyors, known as RICS. And the theme of the seminar today is Decoding Valuation Standards, the implication for financial reporting and investment. And I'm sure you will agree with me that this theme could not be more apt, because the main thrust of the seminar this morning is to look into the increasing need for and the importance for valuation standards, improvement in valuation standards in Nigeria, particularly as Nigeria moves towards achieving a $1 trillion economy. So this morning we have in the room experts in the real estate and financial space for this purpose, to look into this and to discuss this, to talk about how the valuation standards, we can decode valuation standards in Nigeria and the implications for financial reporting and investments. So I'd like to welcome us all to this seminar this morning. I can assure you that every minute spent here this morning is time well spent, and there's a lot of value that we stand to receive here this morning. My name is Olubusola Ogulolu, and I have the privilege of comparing today's event. And again, I'd like to say a big thank you to you for coming, and I can assure you that at the end of the day, you'll be happy that you were here. It will be time really well spent. All right, so before we go ahead, we're not going to waste much time because we're already behind time. We don't want to take too much of your time. But before we go into the events of the day, I'd like to say a big thank you to our sponsors, those who have partnered with us to make this day a possibility. Particularly, I'd like to say thank you on behalf of the organizers to EcoBank, our sponsor. Can we give them a round of applause, please? A big thank you to EcoBank. Would like to say thank you also to FMDQ. Yes, and to Nova Bank. Would like to appreciate them for supporting us in putting together this event. Having said that, we're going to go right ahead to take the welcome address. And the welcome address will be given by none other than the founding partner of Dear Fatimile & Co. I'm sure we are all familiar with Dear Fatimile & Co. Dear Fatimile & Co. is, if not the foremost, one of the very foremost real estate firms in Nigeria. We've been around now for over 4 decades. This is our 42nd year. And it gives me great pleasure to call the founding partner in the person of Mr. Boyega Fatimile to give the welcome address this morning. Please welcome him to the podium.
Good morning, distinguished guests, speakers, panelists. It's my pleasure to welcome you to this important seminar made possible through the invaluable partnership of Business Day, Financial Reporting Council of Nigeria, and the Royal Institution of Chartered Surveyors, and supported through the sponsorship of EcoBank, FMDQ Group, and Nova Bank. When we consider this high inflationary trend in the marketplace in Nigeria today, the ambition for Nigeria's economic growth, and the impact of current macroeconomic conditions on the company's balance sheets, you will agree with me that this seminar is very timely. The theme of the seminar, Decoding Valuation Standards, Implication for Financial Reporting and Investment, is broadly about the importance of valuation standards in Nigeria and to Nigerian economy. There is a firm connection between valuation and global connectiveness in business, and credible valuation standards are critical to achieving the goal of the much talked about 1 trillion economy within the space of, say, 4 years from now. Many firms that are users of valuations do not fully understand the content or the importance or the quality of valuation they are receiving from their valuers. While the impact of this may not be immediately apparent, there are risks attached to such valuations that do not meet international standards. These risks may crystallize at a point in time in future where a firm is seeking funding, especially external funding, it may be critical to the business, or whether in terms of debt from lender or from equity from these sources, both local and international investors, we discover that the balance sheet and the eye we're looking at the company will dramatically change when these risks become crystallized. We do not wait till this stage that these financials may require valuation report, that we need to make valuation standard an important part of our expenditure and expectation for our companies. Proper asset valuation and accurate financial reporting is important, truly, for attracting investment, both domestic and international, into the Nigerian economy, for ensuring credibility of reporting. Proper asset valuation is also essential for preparing financial statements that truly represent the financial position and performance of a business. It affects key financial metrics such as asset values, depreciation expenses, adequate depreciation expenses, profitability ratios, and overall financial health of that company that is presenting itself for investment, whether debt or direct investment. Furthermore, consistent application of asset valuation standards helps stakeholders to make better informed decisions by providing a more transparent and reliable view of a company asset and their impact on the financial statements. It is important that such documents are of universal application that allows an investor to compare and comprehend and rely upon this same document to make informed decisions. They want to make decisions, but they've seen the report, they can't rely on that report, they then drop it. Or call for further investigation to look at what is happening if they are truly interested. Overall, asset valuation standards play a significant role in ensuring the integrity and credibility of reports, thus enabling investors, creditors, regulators, and other stakeholders to assess the value and the risk associated with the company asset accurately. This level of accuracy requires big standard setting, a very essential process for company asset. Whether you report, whether it is money, whether it's the asset, the fixed asset, and all. Valuation standards provide framework for determining the fair value of assets, such as property, equipment, investment, intangible assets, to accurately reflect this economic worth in the statements. To decode these standards, we must promote universal understanding and interpretation of the guidelines and principles and methodologies established for valuing these assets for financial reporting. We must also unravel the complexity of the guidelines and the principles set forth by the regulatory bodies or standard setting organizations such as International Financial Reporting Standards, IFRS, or the generally acceptable accounting principles, which we call GAAP. Those are very important, that we must know exactly those methodologies and accurately reflect them. It requires a deep understanding of specific rules, methods, and assumptions used to value different types of assets, considering the factors such as market conditions, future cash flows, risk, and other relevant considerations such as ESG, which is current now and can also give a direction to what the asset may become, because you can access an asset today, and then you must have a view of what is likely to happen to those assets in the near future. By decoding international valuation standards, financial professionals can ensure compliance with regulatory requirements, apply consistent and reliable valuation methodologies, and provide transparent and accurate financial information to stakeholders. So what do we risk if valuations and financial reporting standards fall short of global standards and best practices? One, inaccurate and lack of credibility. Inaccuracy and lack of credibility for those documents. Increased risk and liability that may crystallize at a time in future. We've seen in terms of Enron, and before you look at it, there was nothing that was left of the company. Limited comparability and transferability. That is, you really can't compare and see how it fits to your general business, assuming somebody is investing from abroad. Limitation to market development. If we don't have it, our market development will either not take off or be extremely slow. What we hope to achieve with today's convening is as follows. One, retain valuation standards as the core of credible financial reporting. Promote the use of best practices, ensuring that valuation reporting in Nigeria can compete with other markets, and establish the importance in international valuation standards in promoting investors' confidence and in the Nigerian economy. Finally, establish the importance of international valuation standards in promoting investors' confidence in the Nigerian economy as a whole. That's why I think the government set up this Financial Reporting Council. To help us to achieve these goals, we have excellent lineup of seasoned providers and users of valuation and financial reporting services, both local and international. It is my hope that their insights and our deliberation and learning today will equip and challenge us all to aim at applying global standards that position us to attract international investment and minimize this business risks and crystallize liability at a point in time. I once again welcome everyone, both people that are here. We have a lot of other people that are joined on the link. I welcome you all and wish you all meaningful deliberations today. Thank you very much.
Can we appreciate the founding partner of Dear Fatimile & Co. again? Thank you very much. You know, I'd like us to come to a gentleman's agreement that would hold just for today's event. Whenever anyone is called up to the podium, please make sure that you're clapping until the person arrives here. And when they're going back to their seat, please keep clapping until they take their seats. Can we agree on that, please? Because it's not an easy feat coming up here to address so many people, not just here in the room, but also virtually. So please, can we appreciate Mr. Fatimile once again for a welcome address well delivered. Thank you very much. You know, like I mentioned at the commencement of this event, I had said that this event is being put together not only by Dear Fatimile & Co., but in partnership with Business Day. So it's only proper that we also take a welcome address from the publisher of Business Day. So it's my pleasure to welcome to the podium Mr. Frank Aibogun, the publisher of Business Day, as he also gives a welcome address. Thank you. Remember our agreement. So keep clapping, please. Thank you.
Distinguished guests, ladies and gentlemen, I will not pretend to match the profound welcome that has been delivered already by our principal partner and founder of the firm, Mr. Fatimile. And so I'm going to try and do this very quickly so I can get out of here and we can then go into the core of our convening this morning. At Business Day, we are all very delighted to be partners with the firm of Dear Fatimile in staging today's event. The point and, of course, the main objectives have already been clearly outlined by the earlier speaker, who, of course, spoke about how it is so important to establish credible and transparent records for the valuation of an organization's asset. And I believe that in the times that we're in, these are indeed very tough times. But what do we see? We see that the experiences are nuanced. Some companies are still able to get by while others struggle. And quite often when you look beneath, what you find is that those that are doing relatively better than the others are those who seek to consistently do things the right way. And I believe that having and pursuing a credible world-class standard in valuation is, for me, an important right way for an organization to conduct its business. We are indeed very excited about this opportunity for the reasons that I've given earlier, but also for the fact that Business Day being the premier business newspaper in Nigeria, you can imagine how excited we are to be part of such a groundbreaking convening this morning. Because anything that helps to contribute to the goal of attaining a $1 trillion economy will be something that I am sure you expect that Business Day will be upfront and be a major participant in. We are grateful that you have found time to come here this morning. I think the point has been made already that all the time you're going to spend here today, you're going to find it worth your while. I have absolutely no question about that. If you look at the program that I'm sure you have in your hand, you can find the very wide array of speakers that have been invited and brought here to speak to you. And I'd like to just say thank you, not just to the firm of Dia Fatimilai and co, but also to speakers who have come here this morning. I have already this morning had the opportunity to speak with a friend who has come in from Nairobi, and we were just exchanging pleasantries. I think the only thing I forgot to ask him whether he has tasted of jollof rice since he arrived in Lagos 2 days ago. But I'm sure we'll talk about that later. So, distinguished guests, ladies and gentlemen, let me not waste any more of your time, but to just say we welcome you warmly and thank you for coming here this morning. And may I also, of course, express appreciation to Dia Fatimilai for giving us the opportunity to stand side by side with them here today, but also an appreciation to the sponsors, EcoBank, FMDQ, and Nova Bank. Ladies and gentlemen, welcome and God bless you.
Thank you very much. You're a wonderful audience. I see that you are keeping up our agreement. Very well appreciated. Thank you very much. Again, thank you very much to Mr. Frank Aibogun, the publisher of Business Day. You know, today is not just about making speeches. There's a lot in store for us today. But it's important that we set the right tone for the event. So, just permit me to call one more person up to give a keynote address, and then we'll dive into the business of today. Like we said, and like Mr. Aibogun rightly reiterated, there's a lot in store for us today. So please just sit back, sit tight, maintain your focus, and I can assure you that you'll never be the same again after today's seminar. All right. So please join me in welcoming to the podium the representative of the Executive Secretary of the Financial Reporting Council in the person of Mr. Ugochukwu Nwora, as he gives the keynote address. Can we welcome Mr. Ugochukwu Nwora to the podium, please? Thank you.
Good morning, everyone. I'm here to represent the CEO of Financial Reporting Council. He is unavoidably absent. He had a national assignment that he has to attend to. So his heart is here. He asked me that I should stand in for him. I want to say that in the Financial Reporting Council, we have a very large heart to really appreciate what Nigeria institution of estate surveyors and valuers are actually doing. To an extent, to the Fatimilai, we have actually really appreciate what you are doing, and we know that what FROC stands for is just quality valuation reporting, and we are hoping that this very seminar will help us to achieve that. I will read from his own note. Ladies and gentlemen, esteemed industry leaders, fellow practitioners, and gentlemen of the press, it is an honor to stand before you today to give an address on the topic, Decoding Valuation Standard, Implication for financial reporting and investment. As many of you are aware, the Financial Reporting Council operates in accordance with the FRC Act as amended through its 7 directorates. We have about 7 directorates, and up to 2024, they have been in existence, half of them. Only in 2024 that we were able to establish the 2 other directorates. The other 2 were all in the arts, but they were not operational. So in 2024, precisely, the ES then made them operational. You have the Directorate of Relations, and that which I'm heading. Then you also have the Directorate of Assurance Standards. They are the 2 additionals that actually came on board this year. So as of now, FRC has the full directors in operation. To begin our exploration, it is important to acknowledge the role of the Financial Reporting Council in safeguarding investors and overseeing the valuation profession for financial reporting purposes. I have to emphasize this because we have had a lot of issues where some individuals feel FRC want to start setting standards for valuers and all that. And we, though it's in our mandate in section 29, but that's not exactly what we are up to do now, because we really have to come in as a new directorate and ensure that the reports that are being issued out that have effect on our financial statements are credible, accurate, and are reliable. So that is the aim of FRC at this time. In a world where accurate valuation holds immense significance in decision making, investors heavily rely on it to make informed choices regarding their investment. We have observed over time in FRC where financials that you pick up, you will observe that I will just give you an instance. One simple valuation report can turn around entire numbers in your FS. And that is why it is important we understand what is expected of us as professionals, especially those that are into valuation. Investors needed to rely on your reports. And if your reports are not credible, are not accurate, are not transparent, we observe that people may end up taking a wrong decision, a wrong investment decision that will impact on whatever asset they are actually taking over from. In Nigeria, for instance, you have observed where a small entity takes over a bigger entity. It's not because they have more asset or whatever to take them off, but because of poor administration of valuation reports. So those kind of things happens. And we are saying in FRC that it will no longer be business as usual. Valuation standards play a vital role in financial reporting, ensuring transparency, accuracy, and reliability in presenting the economic value of assets and liability. the FRC, through its Directorate of Valuation Standards, aims to establish consistent, rigorous adherence to valuation standards and framework. In this regard, I am pleased to share that the Council will soon release the first ever valuation regulation. We have already started it. We have already assembled experts from different stakeholders that are actually meeting now to ensure that the valuation regulation is issued out. We are hopeful that before the end of August, Nigeria will be having valuation regulation. And FRC is going to also ensure that hopefully by July ending, it will be, the exposure draft will be out, and we will expose it for 1 month to allow individuals, entities, and firms paramount for sound investment decision making. Investors rely on valuation standards to assess the value of an asset and make informed choices regarding their investment. By adhering to valuation standards, investors can mitigate risk associated with misjudging asset values, just like I pointed out earlier. Regard about the implication of it. Some years ago, an entity approached FRC. So that you can understand how bad the things are, and said, "Let us know what penalty we are to pay." They want to default. They want to do something that is wrong. And they say, "We want to know how much is the highest amount we can pay if we do this." And they are ready to pay. That's how bad we have come to be. And that is what this seminar we aim at dealing with. And let everybody understand that Nigeria is a nation that is aiming at a $1 billion US, and we cannot have such an investment allow a few individuals to run it down. And that is why every one of us must put in our best to ensure that the right things are done. And then in FRC, we have what we call whistleblowing. If you see anything, do what you said. Don't hide anywhere you are. You could be in your organization that certain things are not done right. Please let us know as FRC. As the FRC continues its mission to promote adherence to valuation standard. Regulatory perspective will play a crucial role. FRC will rely on information they get from the public. They are not magicians. We actually didn't eat what we call it in my local village. We know chop winch to know what happens in your own area. So we expect that if there are things that are going wrong that you feel we need to know, please let us know. FRC will deal with it decisively. And as we discussed in this seminar, I expect that the discussants will take time to look at the role of regulators and ensure that the regulators, apart from FRC, are up and doing. The exploration of regulatory insight during this seminar will provide valuable perspective on the implementation and enforcement of valuation standards. Additionally, we will discuss current market trends and challenges and implement those standards that will help us to overcome those challenges. Continuous education and awareness programs are also essential to foster widespread understanding and compliance with valuation standards. We in FRC are hopeful that at the end of the day, this seminar will tell us areas that both the regulators, professionals need to come together most often to share ideas, because it's as if there is no connection between the operators and then the regulators. We seem to observe that. But with this advent of the Directorate of Valuation Standard, we are hopeful that those loose ends will be brought together again. For accurate valuation, it is paramount for sound investment decision making. Investors rely on valuation standards to assess the values and assets and make informed choices during their investment. I will want to pause here and ask, what are the expectations from the operators when it comes to financial reporting and the regulators? We have had information across board where people say FROC is really after penalties and all that. We will not want to front that as we go into this new era. We will not do that. We will want people to understand that FROC is not out there to penalize. Only those that are guilty will be scared. But for us in FROC, what we want is to see that the valuation reports that have been turned out are credible, as such that anybody coming on board will rely on that. One of the things that FROC did, our cardinal role, is to protect investors. That's one of the things that we do. And in doing that, we want a situation whereby any foreign investor will be confident that there is a regulator in Nigeria who is up and doing, who will ensure that their investment will not be eroded over time. So we ensure that that's our role, to ensure that things are done the right way. We also want to advise all intending investors, you should please come to FROC. We know those that are doing the right things. We know entities of firms like DIA. We are aware that they are doing the right, and that's why they are going high and higher than others, because they are doing the right thing and they don't allow any misgivings in any form. In conclusion, the establishment of the Director of Valuation Standard under the Financial Reporting Council of Nigeria signifies our commitment to promoting transparency, accuracy, and reliability in financial reporting and investment decisions. Through the release of the forthcoming regulation, we aim to establish consistency and rigorous adherence to valuation standard and framework. As we celebrate this day, let us collectively explore the importance and implication of valuation standard for financial reporting. Investment risk specific to Nigeria's circumstances, and the role of technology should not be overemphasized, because we are actually living in a global world where whatever happens here, it also affects other environments. Thank you for your attention, and I look forward to engaging in interactive discussion throughout this seminar.
Thank you very much to Mr. Ugochukwu Nwora, the representative of Dr. Rabiu Olowo, the Executive Secretary of the Financial Reporting Council. Thank you very much. Thank you very much. You are doing very well. Maybe extend that clap for yourselves as well. You're a wonderful audience. Thank you very much. Okay, beautiful. We're moving on. You know, in this room this morning, we have experts from the financial sector. Particularly, we have experts and professionals from the banks, from the audit firms, the Big Fours, from rating agencies. We also have in attendance here, physically and virtually, our colleagues in the real estate space, property developers. We also have in attendance our regulators, institutions, even representatives from the academia. I want to say a big welcome to all of you. Thank you for coming again. We have in our midst this morning the chairman of the Lagos branch of the Nigerian Institution of Estate Surveyors and Valuers, in the person of ESV Benga Ismail. Sir, if you are here, we'd just like to acknowledge you. Thank you very much. Thank you for coming, and thank you to all of us. So we're moving right into the next activity, which is the fireside chat. You know what this fireside chat is? You know, sometimes we see on television, we see the President of the United States just sitting talking to another president just by the fireside. So we're replicating that this morning. And to anchor that, I'm going to be calling up to the podium, again, the founding partner of Gia Fatimilei & Co. in the person of Mr. Boyega Fatimilei. And he will be having that chat with none other than Mr. Chris Thorne, who is the CEO of Valuology. Mr. Chris Thorne is a seasoned valuation expert with extensive experience in the UK commercial real estate market and global engagement across various asset classes. He's a fellow of the RICS, RICS being the Royal Institution of Chartered Surveyors, and RICS is also one of the organizing partners for today's event. So he's a fellow of RICS, and he has held key roles, including technical director at the International Valuation Standards Council and senior director at the BNP Paribas Real Estate. Mr. Thorne has served as on numerous risk boards. He has contributed to valuation standards and advised on cross-border regulations. He's a published author, a global speaker with significant experience as an expert witness and arbitrator in valuation disputes. And he also heads the organization called Valuology. So who better than to speak on valuation than someone that heads an organization called Valuology? So it's my pleasure to welcome virtually Mr. Chris Thorne, will be joining us virtually from England. I'd like to welcome Mr. Chris Thorne and also welcome the founding partner of Dia Fatimileye & Co. as he moderates this fireside chat, looking at decoding valuation standards, the implication for financial reporting and investments. Please join me in welcoming the speakers this morning. Thank you very much. Thank you, Mr. Thorne. You're very welcome.
Thank you.
Designed to address the core concerns of firms that needs valuation reports, not just companies with significant real estate holdings, but also those with other tangible assets such as plant and machinery and IP valuable assets. This seminar is primarily targeted at these users of valuation reports for financial reporting, compliance, and investment purposes, with the aim of giving them a deeper insight to various aspects of this process, which you are renowned to be very, very vast. When I see Valuology, what first of all occurred to me is zoology that leads to deeper understanding of what valuation should be. So we will be able to distill some good information to our audience here, both here and on the link, both the link and on YouTube. So you have a very wide audience all over the place. I'm sure some people are watching you from both UK and other African country on this matter. So my first question to you is, what I would like to do is actually want you to make some remarks before I go to those questions that will highlight some of these important issues in relating to our present topic of today. Can you hear me?
I can hear you fine, yes.
Okay, fine, thank you. So I just want you to also address the House briefly before we go to the details of this questioning and see how it will work. So you can. Chris, you have the floor.
Okay, well, thank you very much for that introduction. I wasn't sure I recognised too much of it, but as you can tell from my hair colour, I have had a bit of experience in valuation, so I am very pleased to take part in this discussion. I did come out and talk live to a conference on this subject in Lagos back in, I think it was 2012, and it's good to see there's been some progress in the organisation of valuation, and particularly around financial reporting since that time. And I look forward to learning how things are moving forward in the country, and also providing any tips from my experience of the subject elsewhere.
Thank you very much. My first question here is actually asked, can you enunciate for us the purpose of valuation? What is the purpose of valuation from a valuology point of view?
Well, I mean, the purpose of valuation is it's a measurement of an asset or liability, and it's core to business decisions. You know, it helps justify sell or purchase decisions made by a business. It's needed for establishing the value of collateral for lending, looking at investment performance. It's very prevalent in the banking sector, where regulators want to see not only the collateral values, but how banks are treating assets on their books as part of their financial stability requirements under the Basel regulations. But yes, it's a vital cog in the overall business environment.
Okay, so the valuation call to business, call to bankers, especially when they call for their mortgage valuations to be able to determine how much they'll be able to lend against such assets. But
That's right, yes, yeah.
okay. The importance of standards in valuation. How do we tie this to the importance of an adequate and rigorous standard in valuation reporting?
Well, it's very important to have standards in valuation. I mean, a valuation is a theoretical transaction. It's not something that actually exists. So therefore, you have to have rules around how that hypothesis is developed. And those need to be common so that you can compare one valuation with another valuation. So having fundamental standards as to what definitions or bases of value can apply, the commonly recognized methods which will be used, and how valuers behave, importance of ethics in terms of their independence and objectivity are absolutely vital if people are going to trust valuations, because if people don't trust the way valuations are delivered or understand how they're delivered, then they cease to have any relevance.
Thank you. Like you said, yeah, valuation is actually theoretical issues. Look at an asset and theoretically build a scenario around it to give you what the likely value will be in the market at that time. So standard is important. But can you give us a brief overview of the international standards prepared by Royal Institution of Chartered Surveyors, the Red Book, the Red Book standard? We also have our own standard book here in Nigeria. We call it Green Book.
Yeah.
And it's extensive too, but we are also refashioning it. But we would like to have your view and overview of this Red Book and see how it can impact on the valuation produced for the consumption of international market.
Well, I've already mentioned how important the need for standards is. And I mean, that's been recognised for a very long time. I think the first standards in the USA for valuation were developed in the 1930s, or so I'm sold. I've never actually seen them. The RICS first issued specific valuation standards in the 1970s. And there were developments in other countries of standards as well, but increasingly it was obvious that as we got more and more international trade, as the world was moving towards agreeing common global accounting standards, that there needed to be common global valuation standards. And the IVS, the first IVS were published around the beginning of this century, although it had been in development for at least a decade previously. And there's been gradual alignment over that time with the international standards, which themselves are continuing to develop with the national standards. So, for example, the RICS Red Book sets rules for its members, but it follows all the principles which are in the international standards and adopts common language, common definitions, wherever those are applicable to the work that its members do. And this is a trend which is carrying on around the world. I was at the IVSC, where on the board, and then as a director for about 15 years, and there was a significant change over that period. So, and I also did see some early drafts of the Nigerian Green Book when that first came out, and I can see that's following very much the same pattern as the RSS standards as well. So it's great to see there is this alignment, because that is vitally important, that people are using consistent definitions and consistent approaches if global investors are going to have confidence in the valuations they see in accounts and elsewhere.
Thank you. I just want you to tie this connection between those institution-based valuation standards and the International Financial Reporting Standards, the IFRS. What is the connection, and how are they interwoven to be able to give a credible and more acceptable reporting in international financial records?
Well, there's no formal connection between the International Valuation Standards Council or the International Accounting Standards Board, but we do recognise their common interests. And if we look at the accounting side, about 20 years ago, the IASB and the US equivalent, and the US doesn't actually use IASB but has its own developed accounting standards, reached agreement that they needed to produce a common standard on valuation. And there was very close cooperation between the IVSC and both the FASB and the IASB in developing their respective standards. The Americans were first out of the traps when they developed what was initially FAS 157, it's now Topic 820 they call it, and that was followed a few years later by the ISB's document, which is IFRS 13. But the valuation profession had a lot of input into that. I was invited on at least 3 occasions to meetings with the ISB board to discuss certain aspects of it, and for 3 years I was sitting on a advisory group to the FASB in the USA as well. So there was a lot of input coming from the valuation profession into the development of those standards. And although they are quite clear as standard setters, they are independent, they're not going to be beholden to any other organisation, they have their own definitions. That's the reason why they have a definition of fair value, which means effectively the same as the IBS definition of market value, but they have to have their own definition because they can't depend on a definition set by an outside body.
So but I would have thought that the outside body around the world will work together to ensure that those definitions of what a fair value will be or what a market value will be is quite understood, so that there'll be no variations that can lead to extended or manipulation of figures that can later lead to extensive risk carriage over the period, over a long period. You know, when it accumulates and the standard varies over the period, it can accumulate, creating a big hole within the financial reporting papers, and then a big risk. So, has there any effort been made to actually ensure that there is an understanding on these definitions, because they are quite important?
Exactly, and I mean, the accounting standards, the fact they've got their own standards with about 80 or 90 paragraphs in both the US and they're, apart from about 2 sentences, the American standard, Topic 820 and IFRS 13 are exactly the same. But they go into significant detail, but none of that is something which would cause any conflict with the IVS at all. They looked at the IVS conceptual framework for market value and said, well, a quote I got from the ISB was, that looks kind of neat, but we need more detail for our accounting sector. But there's nothing in there which is contradictory. I think we have to remember as well is that the IVS, although it is embraces all assets, a lot of the history of it is embedded in the real estate markets, whereas the accounting standards primarily focus with IFRS 13 has been probably on the financial markets and valuation of financial instruments, leases, and this sort of thing, because outside property investment companies, it is those financial assets are the assets which have got by far the biggest numbers attached to them. And as we saw in incidents like the 2008 crash of Lehman's, are the ones which have got the greatest potential to cause problems in the wider markets.
In the all today is that, why are standard important from this point of view? Financial reporting, investment, and risk management perspectives.
Yes, I've said previously, I mean, it's important, you know, the standards. If you don't have standards on valuations, people understand what it is they're trying to achieve and are trying to achieve it in a consistent way, no one's going to believe valuations. So the fundamental level, that's important. I mean, there are subtleties between all the different purposes, and that's why it's very important that the valuer understands the purpose for which a valuation is being used, and when they provide it, put warnings on it that it may not be suitable for other purposes, because there's no such thing as a universally applicable valuation. But you can see, you know, financial reporting, I've already mentioned IFRS 13, which is applicable in any country that adopts IFRS for measuring the fair value of assets and liabilities. I should add there that whether or not you can apply fair value is not determined in IFRS 13. It depends on a whole range of other accounting standards. It crops up in lots of them. The only one where it is mandatory to actually report the fair value or at least refer to it in the notes to the accounts is for investment property in IS 40. In most of the others, it's an option alongside cost less depreciation as a measurement for accounting. But if we move into financial sort of investment decisions, certainly boards of companies, trustees of funds and pensions and like need to know that investments they're making, they're paying the right price for it, and investments they hold, they want to see what returns they're getting from them and understand what value those are at any given time. So it's very important to have standards that are applicable for that. And from risk management, valuations fluctuate, and obviously we've seen that a lot over the last 3 or 4 years due to reasons, first of all, the COVID disruption, then the problems in Ukraine and the disruption of oil supplies have caused some rapid changes in interest rates and currency exchange rates around the world, which are all impacting on markets. Having frequent valuations and revaluations is vital to understanding the risks and measuring those risks on a regular basis. Certainly in the banking sector, banking regulators, certainly in Europe, where they have to follow a common standard across the whole of the European Union, the credit requirements regulations. I mean, they have required banks to keep monitoring values on an almost consistent basis when there is rapid change in the markets. Not all of them, or few of them, are doing it very well, I have to say. But I mean, that just underlines the fact that regulators are very concerned about the need for valuations to be kept up to date, and that the risks which are being faced by a business from falling values or changes in the markets are properly understood.
I'm quite clear with that, but there's, when you talk about continuous valuation, especially in a fluid and uncertain economy that we have been thrown into since COVID, I would like to reserve that question to a later date to just make a comment on it. So I will go to the next question quickly. What are the appropriate type of valuation methodologies for different purposes? If you can just highlight them, because this will enable us to unravel quite a number of details that are provided in most standard books for valuation regulations. So what are the appropriate valuation methodologies that we should use? Yes, for those purposes, for various purposes.
Well, it's very important that valuers understand that there is no right or wrong method for any particular purpose. The only tip I would give is that you need to understand how market participants in that particular market would price an asset and use that method. Sometimes you might use more than one method just to do a cross-check, particularly if you've got an asset which is difficult to value or for which you don't have a lot of data. But you should never start averaging the results of different methods. If you find different methods produce different results, it tells you need to look more carefully at the inputs you're using in those different methods and try and reconcile them and find out where the differences are. But there's no such thing as, a single method is always going to be suitable. And this is common. If you look at IFRS 13, it's quite clear that you can use what it calls the three valuation approaches, which are the market approach, the income approach, and cost approach. The IVS says exactly the same thing, as does the RICS Red Book. Within those particular categories, you have vast numbers of subtle variations, particularly in income approach. I mean, I was told once by an academic at a US university that there are over 120 books published on how to calculate the equity risk premium, which you think with different methods, and you think, well, that's absolutely crazy. I mean, how difficult is it? You just observe the fact that treasuries are yielding 2%, and equities in that sector are yielding 6%. So what do you need to calculate the fact that the risk premium there is 4%? But somehow there's enough academic debate on the subtleties of that to justify 120 different books being produced with theories on it. So I think the message there is people can get very bogged down in methods and distracted by it. And it just underlines the fact that valuation is not purely an academic discipline. A good valuer has to understand the market and observe it and understand how those market participants price things, what they're thinking about the future, when they buy and when they would not buy. And that is far harder data to collect, but it comes from experience and knowledge and contact with the actual market in which you're valuing, which is absolutely a vital component.
Thank you. So the experience of the valuer is important, and the method can be determined by the one that has the most prevalent data, and that you can use 2 or 3 methods to cross-check and see whether you are within limits. Thank you. How do we ensure that property and tangible asset valuation meet the required standards of financial reporting?
Well, it's not that difficult. If you're valuing the property for any purpose which envisage an exchange or a sale, that is accounting fair value. And say where valuation is used as a measurement, that is normally the basis. There are 1 or 2 other slight variations, but that's really whether or not you deduct costs or add costs to the figure which is being reported for different purposes. For example, if you've got an asset which is surplus and you're looking to sell it, then an accounting standard called IFRS 5 comes into play, and that says that the figure you're reporting in your accounts has to be the fair value less the cost of disposal. In other words, the net receipt you're going to get from that. Whereas if it's an asset you're holding on to, you don't take account of costs. So there are little subtleties like that, but those don't really affect the advice the valuer is giving. That's really for the reporting entity to make those different adjustments. The important thing is that as IFRS 13 says, you've got to use the method or approach which is the most suitable for that asset, one which most market participants would use. So it's exactly the same as market value. You have to reflect the highest, for physical assets anyway, you have to reflect the highest and best use, which is defined exactly the same way in IFRS 13 as it is in the international valuation standards. It's not the highest possible use you could imagine. It has to be physically possible. It's got to be legally permissible and financially viable. So it's not, all it's saying is that the figure which would be agreed between 2 equally informed participants in the market, the buyer and the seller, the seller's trying to get the highest price they can and the buyer's trying to get the lowest price they can. They will both know what the highest possible use of the property is. So that should be reflected in the valuation which you provide. I think the only place where we've actually found any difference between IFRS 13 and market value is when you're valuing a shareholding which in the market would hold the balance between a minority and a majority holding, because those can reflect a premium. As IFRS 13 is written at the moment, and FAS topic 180 in the USA, the you have to ignore it. You just have to look at that bundle of shares which might be able to be sold to a minority shareholder to gain a minority. You ignore that. You're looking at the general market price, the P times Q price of that particular holding. But that is only specific to that particular situation. I think that's the only difference we've actually found between the way fair value is applied and way market value in IBS is applied.
Crave your indulgence, so open your memory. If you can provide us some case studies on how valuation errors can impact financial reporting as well as investment returns.
Well, I have to be difficult here. I've got to be careful about confidentiality here, so I will have to be. Forgive me if I'm not giving very precise names or places.
You don't need to give names. We don't need to give names, but just give us scenarios so that we can appreciate this issue.
Yeah, well, I mean, in recent years, I have been giving advice to various regulators around the world who are investigating financial statements. And I think there's one looking at the financial reports being put in by a real estate investment trust in a Middle Eastern country. And they were suspicious with the valuations, which, seem to be increasing the value of the portfolio by a small amount every year, whereas their perception was, the regulator's perception based on other figures, was that the office market in that location had fallen by about 20% over that period. And they got me in to see whether these valuations were complying with international standards. And it became clear to me that they weren't. They were not giving clear rationales for the changes in value. They were not, which is something required by IFRS and international valuation standards. They were not keeping records of discussions they were having with their client over the values which were being proposed. And the regulator did have some evidence that the client was leaning on the valuer to change the valuations, and the valuer was complying. And there was, I think when I looked through them, I found 8 different reasons why the valuations produced did not comply with the standards they claimed to comply with. Yet in spite of that, over that period of 5 years, 2 of the big 4 accounting firms had audited these accounts and had said in the notes that they had reviewed the valuation reports and were satisfied that they complied with all standards. So it underlines there that there is still a large compliance problem certainly in that location. I think they avoided a court case in the end, and the company in question paid 500 million fine or something. But it was that's an example of where regulators are looking very closely at whether valuations are compliant, and that there's instances out there where, well, it's not that uncommon to find examples of where those standards are not being complied with. I can give you another one as well. I mean, in the banking sector at the moment, where banks are having to constantly monitor their values in the changing markets, and they are not writing down their collateral values sufficiently, arguing that, well, because there's been no market transactions over the last 2 years in that sector, there's no evidence to show that the market value they put on the assets in 2021, say, are any different now, which is absurd because that you must not just look at completed transactions. You have to look at when markets start turning down. Of course, transactions fall away because people with those assets are less inclined to sell them, and people who want to buy them are less inclined to buy until the situation becomes clearer. But you have to have regard to market sentiment. This comes back to the point I made that a good valuer must understand the market and what buyers and sellers are thinking at that time. And that, when there's not much transaction data around, is a very important input into your valuations and something you cannot disregard, and you have to write your figures down to reflect that.
Like that, I mean, I can give you an example, especially with the organization that had to do to show their valuation year on year. There is an inbuilt understanding with them that these values must go or go, even when underlying cash flow is not supporting it. So it could happen. But finally, I would want you to talk a little bit on emerging trends in valuation and what their impact will be, like technology, like ESG factors that is now actually having a grounding in the real estate terrain. Just a rendezvous on those aspects of it as your experience has carried you.
Well, given when I first started valuation in the 1970s, everybody was using manual typewriters, and a valuation report was, if it was 2 pages long, you were lucky. Because and if you made any mistakes, your typist had to retype it all again. I think, I've seen many technological changes over that time. I won't actually call them advances in some cases, because in some cases the skeptic in me says they would be not at all helpful. But there's no doubt there's so much more data available to people now, and there's greater automation of that data. But certainly when it comes to the commercial real estate market, I've yet to find anyone who accepts that there's yet been a model produced which can be reliable, because real estate, particularly commercial real estate, is so heterogeneous in terms of its, it's very difficult comparing one piece of real estate with another, even if the buildings look identical. Internally, they could have different services, they could have different layouts, have different finishes, and of course they're bound to be in different positions, which again can have a big difference. Building all that into automated data is something no one's really achieved in doing yet. In the residential markets, it is automated valuation tools are being used more widely now for cross-checking portfolios and things like this, where there's particularly in markets where you've got a large number of very similar assets. I'm thinking here places like Dubai, where you can have sort of a dozen almost identical blocks in a row, all with the same number of virtually identical apartments in them, the only differences being whether they're facing northeast, south or west. And automation tools are being used in markets like that with a degree of success and acceptance, but even in that market they haven't found a way of applying it to commercial real estate yet. On the sustainability point, I think it's vital that valuers are aware of the impact that ESG and particularly climate risk is having on property prices and the way it affects the demand of buyers in the commercial markets. Residential markets, there's not so much evidence coming through that an energy efficient house is going to be that much more valuable than one which is not energy efficient, which defies logic, but that's because there's so many more subjective factors which probably influence whether or not you buy a house in terms of, is it in the right area for the school you want to send your children to or close to your friends. I mean, there's so many things there which you can't really capture. But in the commercial market, and particularly in offices, it's having a quite observable effect where office buildings which were absolutely top class only 20 years ago are now rapidly, only worth probably half that of a brand new building, which has got all the latest energy efficiency ratings. So you are seeing this polarization of the markets and in the commercial sector due to the way in which market participant buyers, in particular tenants, are wanting to look for buildings which can tick their own sustainability criteria. And that's what valuers should not be doing, is suddenly making those decisions for the market and making arbitrary deductions. They've got to observe what the market's doing and reflect what the market's doing. So that's the main message there.
Thank you, Chris. I think we need to give him a heavy round of applause. It is difficult to unravel 45 years or so experience in under 20 minutes. We thank you very much, Chris, and we look forward to seeing more of you very soon. Thank you very much.
My pleasure.
Thank you very much. Please don't go, sir. We'll be taking a few questions now. Thank you very much once again, Mr. Chris Thorne. Thank you very much for your time. Thank you, Mr. Fativilain. Thank you very much. So this is the time to take questions. I'm sure we might have a few questions that we might want to ask from Mr. Chris Thorne. So if you have your question, maybe for those of us in the room, you can please indicate, and the microphone will be brought to you. For our distinguished participants online, you can please type your question in the chat box. We'll take a few questions, and then we'll move on to the next session. So any questions in the room? Do we have any questions or any comments? Any questions? We'll just take one or two. Do we have online? Do we have questions online or comments online? Okay, so everything, we're good. Okay, we have one question there. Can we please take the microphone to him, to the gentleman in the corner there? Thank you.
Good morning, everyone.
Good morning.
My name is Jonathan.
Thank you.
So I'm a technology entrepreneur. I wanted to know if there are any standard...
Maybe you can stand so that everybody can see you. Thank you, if you don't mind.
Good morning, everyone. My name is Jonathan. I'm a technology entrepreneur. So I wanted to know if there are any standard tools that are currently existing for valuation purposes.
Okay.
I'm sorry, there was too quiet, so I couldn't hear the question.
Okay. Please
Bit
raise your voice.
more volume.
Is it clearer now?
Yes.
Yes, it is, that's good.
Alright, so I wanted to know if there are any current valuation tools based on the current technology trends and AI. do they have any existing standards tools for valuation right now? Or is there anyone you recommend?
There's quite a lot of, if you look at the latest version of the international valuation standards, and I can't quote you from it, but they certainly have some advice in there on the use of automated models. Of course, the other thing is you've got automated valuation models. You also have the use of artificial intelligence to help developing valuation reports, which are two quite different subjects. I've got a client who's looking at the latter at the moment and trying to speed up their report production, which has there's a lot of technology going into the way they produce their reports, which saves time and enables them to process more of them in a day. But that isn't actually, that's a sort of standard text and making sure the right text appears in the right circumstances. It's still text which has been approved and generated by a person. But I think we're some way off, about asking ChatGPT or someone like that, say, please tell me the value of number 15 Lagos Avenue or something like that. I think that we're a very long way from that. And would anybody believe the answer that came out? I think the answer to that is probably no. But yes, I mean, as I said at the beginning, I've seen huge developments in technology, from I thought it was pretty advanced when I first started working in the 70s, walking around site with a miniature dictaphone, recording notes rather than writing down on a piece of paper, and then taking them back to the office, giving a tape to a secretary to type all that out for me. I mean, that now looks like ancient history compared with what happens now when you've got all these apps on your phone which can basically do all this for you and then translate your photographs and things straight into your report and what have you. But it's, you never know what's coming there in the future, but I think we're a long way away from having a full automation of valuations, particularly in the commercial sector.
All right.
I hope I answered the question there.
Sir, I hope your question has been answered. All right, thank you very much. Okay, we have another question there. Thank you, Mr. Thorne. We have another question in the room.
Okay, good morning, everyone. I'm Manifat. Okay, so from the scenario you painted, are there sanctions for institutions that do not comply with international standards for valuation, especially where the Big Four has confirmed or said that the institution complied with the standards?
Yes, I think I think this is sort of just an education problem where, whereas you look at accounting standards, they have massive financial backing from those same Big Four accounting firms and many others as well, and governments, and they have got so much more resources than the International Valuation Standards Council, which by comparison is it's a tiny organisation compared to the ISB, and relying heavily on the major professional bodies such as the Appraisal Institute in the States, RICS, and the Australian. I can't remember. I don't know offhand whether NICF are a member of IVSC. But hopefully they are. But it doesn't have anything like the resources, and therefore it means it can't get the publicity or the materials out there which the accounting standard setters do, and therefore it's a constant battle. You need events like this are great, but they're only just scratching the surface. You need a lot more understanding of what valuation standards are, the importance of them, and the problems which should be looked for. particularly by auditors when they're looking at valuations in company accounts, as to what those standards are and why they're there. So yes, it's an ongoing battle.
Okay. All right. Thank you. Has your question been answered? All right. Thank you very much. Do we have any other question? Maybe we can take one more. Otherwise, we'll just go ahead. All right. Okay. So thank you very much, Mr. Christon. We're not saying bye-bye to you yet because we know that you'll still be sitting in on the second panel. So thank you for your time so far and looking forward to seeing you again shortly.
My pleasure, and see you shortly.
Good. Thank you very much.
Goodbye.
Right. Thank you very much. Yes, I think he deserves a good round of applause. Thank you. Thank you. So we're moving on with the program for the day. As you can see, the hall is almost filled to capacity now. In the course of the last session, we had people that, other participants that have come to join. I'd like to acknowledge the presence of the chairman, the representative of the chairman of the Real Estate Developers Association of Nigeria, in the person of Dr. Adeniyi Adeyemi, who himself is the chairman of the Ogun State chapter of REDAN. Thank you very much. Thank you for coming. We can do better than that. Thank you. I'd also like to acknowledge in our midst ESV Ashiwaju Doshufatokun, who is the chairman of ESVABON. ESVABON is the Estate Surveyors and Valuers Registration Board of Nigeria. Ashiwaju Doshufatokun, thank you very much. And as we acknowledge him, I'd like to invite him up for a brief goodwill message. You'll be giving us a brief goodwill message just in a few minutes, and then we'll move on to the next session. Ashiwaju Doshufatokun, please come up to give a brief goodwill message. Thank you very much. Please note that, yeah, please, okay. Thank you. You remember our agreements. Thank you very much. All right. For those of us who are just joining, we have a gentleman's agreement that whenever anyone is coming to the podium, you keep clapping until they get here. Thank you very much.
Good evening, or good afternoon, or morning, gentlemen and ladies. I represent the Estate Surveyors and Valuers Registration Board. In Nigeria, this board is the regulatory body for all issues relating to valuation profession. And first of all, I want to commend the initiative of our member, credible member, Gia Fatimilen. This initiative is quite welcome and commendable. If we had been notified much earlier, in fact, we would have given not only moral or institutional support, but financial support. As a federal government agency, the way to take money out from such body is very tedious. Hence, we are not able to participate financially. That said, I want to let this body know, this audience know that the board is the custodian of all valuation issues, including standards. So when you talk of standards, the first port of call is the ESVABON. And we want to let you know that our standard in Nigeria is second to none. We collaborate with ISVA, that is International Valuation Standard Committee. This is the foremost technical body that tends to integrate all valuation principles, technicalities, or with all the continents of the world. And of course, we partner with our sister institutions like RICS. Well, most members in Nigeria are members of RIS. And of course, we partner also with International Financial Reporting Council. And before our own local financial council came into being, there has been Nigerian Accounting Standard Board. We have also partnered with that board and collaborated with that board. And I want to let you know that the issue of financial reporting is a purpose in valuation. Professional valuation is undertaken for specific purposes. And earlier in the profession, we had identified general financial purpose, of which financial reporting is a subset. And since you can recall in this country, awareness has been created for valuation for financial reporting since the indigenization decree of the 70s and the 80s, followed by the privatization and the commercialization scheme of the federal government. The issue of reporting accurately of valuation has been on the front burner. So it's not really a new thing, but we thank God that from time to time we continue to look at every other issue. And just to conclude that the ex-Vabon and the profession has respect, utmost respect, for the consumers and users of valuation reports. You know, we want to learn, we want to develop. In terms of standard, as Mr. Fatih Lemu has said, we have the Green Book of the ex-Vabon, which integrates all the best practices in the profession in the world in it. So I want to let you have the confidence that our valuation reports are standard in this country. Of course, like any other profession, there can be bad days, but from time to time we take care of it. We thank you for coming, and we commend the organizers of this conference or seminar for a good job done. We welcome more of it in the country. We welcome more from any angle, but make sure you confide in ex-Vabon and you carry us along. Thank you very much.
ESV Ashiwaju Doshufatokun, the chairman of ex-Vabon, thank you very much. Please let's keep going until he gets to his seat. Thank you very much, sir. Mr. Chairman, sir, I want to say that it's not too late for you to still support us financially. You can commence the process now. We're happy to wait. But thank you once again. Thank you very much once again. Please let's appreciate him once again. Thank you very much. Okay. So, and on that note, we'll also again like to appreciate our sponsors, EcoBank, Nova Bank, and FMDQ. Thank you for making today possible. We're moving on in our program, and we're going to be taking the first panel discussion. We have two panel discussions for today. We're taking the first one now, and right after the first panel discussion, we'll be taking a break for tea. I can assure you we have very sumptuous refreshments for us. So after that, we'll come back in, we'll take the second panel discussion, and then we'll have lunch and we'll call it a day. So again, I'd like to thank you for your time, thank you for your patience so far, but I'm sure that you can see that this is time well spent. So for this first panel discussion, allow me to call up to the podium our discussants for today. We have three of them and one moderator. The first discussant is in the person of Mr. Ben Elder, FRICS. Mr. Ben Elder is the Global Director, Valuation of the RICS, and he's responsible for delivering the RICS Global Valuation Strategy, crucial for global financial stability through the application of international valuation standards. He's a professionally qualified chartered surveyor with a track record of creating high-level strategy to drive improved markets in the real estate sector. He's an economy, property market interface. He's an economist and chartered surveyor, and he has a keen interest in the economy property market interface. He has held senior academic roles at Nottingham Trent University and the College of Estate Management. Since joining RICS in 2011, Mr. Elder has served on various boards of the RICS, including the International Governing Council. He chairs the IVSC Tangible Asset Standards Board and the FIG Commission, Commission 9. He has contributed to a handbook of sustainable real estate called the Routledge 2017. Please join me in welcoming to the panel virtually this morning Mr. Ben Elder, the Global Director, Valuation, RICS. RICS being the Royal Institution of Chartered Surveyors. You're very welcome, sir. Thank you for joining us. Also, as our panelists for this session, we have Mr. Silvanus Eneche, CFA. Mr. Silvanus Eneche is the Chief Risk Officer of Wema Bank PLC. He's an experienced Chief Risk Officer with an extensive history working in the banking industry. He's skilled in business planning, banking, management, mergers and acquisitions, and private equity. He is a graduate of the Lagos Business School and Pan-African University, and he's also a CFA charter holder. Please join me in welcoming Mr. Silvanus Eneche to the platform this morning. You're very welcome, sir. Mr. Yes, please sit down. Thank you very much. All right, joining us also for the panel, this panel discussion, is the CEO of UPDC PLC in the person of Mr. Odunayo Ojo. Mr. Odunayo Ojo is a consummate real estate professional who has been involved in property development, asset management, private equity, and advisory services for various asset classes, including master planned communities, mixed-use schemes, shopping centers, commercial business, and hotels. He has held several roles, such as the CEO of Alaro City, Director of Development and Projects at Eagle Hills, Abu Dhabi, Development Director at Loros Development Partners, Vice President at Ocean and Oil Holdings, and Business Manager at UPDC PLC. Mr. Ojo is a member of the RICS and National Institution of Estate Surveyors and Valuers, the NAIVs, and also a registered surveyor and valuer. He holds a master's in business administration and a bachelor's degree in real estate management. Please join me in welcoming to the podium Mr. Odunayo Ojo. Thank you very much, sir. You can see the quality of personnel that we have this afternoon to take these discussions. You're welcome, sir, Mr. Odunayo Ojo. Please take your seat. All right, so also we have joining them the only lady on the board, on the panel, in the person of Ms. Uloma Ojinma, a partner with PwC Nigeria. Mrs. Uloma is a partner with PwC Corporate Reporting Services team in Nigeria and also supervises the PwC Nigeria Business School. She's an accredited member of the PwC Global Corporate Reporting Services team and specializes in the financial services and energy industries. Oh, okay. Thanks. All right. Apologies. I'm just being informed that Mrs. Uloma would moderate the second panel. All right. So to moderate this panel, we have Mr. Jamiu Adeyemi Olakison. Mr. Jamiu Adeyemi Olakison is a partner and assurance leader with Ernst & Young West Africa. And he's also the assurance leader for Ernst & Young West Africa. He's a partner in the financial services sector of the audit unit, and until 2018, he was the leader of the financial reporting group in West Africa. He's a thoroughbred professional accountant with extensive experience in teaching accounting and in professional practice. He holds a BSc, first class, in applied accounting and is a fellow of the Association of Chartered Certified Accountants, FCCA. He's a fellow of the Institute of Chartered Accountants of Nigeria, FCA, and an associate member of the Chartered Institute of Stockbrokers, ACS. Please join me in welcoming to moderate this session, Mr. Jamiu Adeyemi Olakison. You're welcome, sir. Thank you very much, Mr. Jamiu.
Good morning, everyone. It's actually a privilege for me to be here this morning to moderate this first panel. The theme of today's conference is actually Decoding Valuation Standards, Implications for Financial Reporting and Investments. For this first panel, the focus of our discussion here is going to be on valuation trends and methodologies, consideration for the Nigerian real estate sector. Let me quickly give you some background. It is a known fact that valuation can be done for a variety of reasons. But the focus of this conference is actually on financial reporting and investment. So that means we streamline the focus. We are not going to talk about the other area. And what this shows is that for me as an accountant, I'm not a valuation expert, to be called upon to moderate this session in the midst of the valuation expert, it shows that there is a point where valuation experts and professional accountants connect. This topic that we are going to discuss at this panel aims to address the dynamic and complex landscape for tangible asset valuation in Nigeria. And during this session, we aim to equip participants with knowledge and insights on a number of issues such as emerging trends in valuation, which is going to be a continuation from the fire chart that we had earlier, particularly the impact of technology, sustainability, and market conditions on valuation. We are going to look at economic conditions. About 4 years ago, we had COVID-19, and we've had economic headwinds that have had significant impact on valuation globally, particularly for commercial properties. Sustainable buildings are also having valuation premium added. In Nigeria, the recent devaluation of the local currency has had a significant balance sheet impact on listed multinational companies, including those that are not listed as well, because quite a number of them have liabilities that are denominated in foreign currencies. What this has done is that it has led to several companies looking at options around their accounting valuation of the assets that they carry in their financial statement. There are various valuation methodologies that are used in Nigeria. We examine at this panel the limitation in Nigeria of each of the common valuation methods. Critical here will be how limited data transparency, which is peculiar to Nigeria, could impact the accuracy of valuation. For example, information to support the output of many valuation reports, which is one of the areas of concerns for us as auditors. Another consideration is the lack of significant data of transactions from which to obtain observable capitalization rates or initial yield that can be used for valuation. Without wasting too much of our time, I'm being timed, and I can see the time has started counting. Let me start with the first question, which I'm going to direct to Mr. Odunayo. And the question goes thus: what are some of the significant valuation trends you have observed in the Nigeria real estate market in what has been a volatile period for the economy over the last 12 months?
Good morning, everyone. Can everybody hear me? It's a pleasure to be here, and I thank the organizers of this event for inviting me to participate. So, in the last 12 months, we've seen a high rate of volatility. As some economists have said, it's almost a perfect storm in the Nigerian economy because we have the triple effect of increasing interest rates, devaluation of the currency, and inflation. So these factors on their own, individually, could cause significant disruptions in the market. But in Nigeria, we are facing three of them at the same time, which has meant that, practitioners have had to face serious challenges on how to navigate these economic headwinds. So some of the trends that we are seeing across the market in the last few months and even years, a trend, so it's beyond 1 year, is that we are seeing a lot more reliance on data in decision making and in determination of values. And that is a trend that is also more or less universal. We are seeing this trend across many other jurisdictions of the world, whereby the advent of big data in decision making, the advent of empirical evidence in decision making has also crept into the practice of valuation, which to a large extent was based on opinions. A valuer's opinion is based on a series of factors: experience, location, and so on. But empirical evidence and use of data has become more and more prevalent. We've also seen the use of technology becoming more and more applicable, especially in the area of automation and calculation. I remember back in the days in school, we used to rely on such tools as Paris valuation tables and some very analog methods of determining some factors. But now we are seeing more and more use of technology. We have models. A lot of people use Excel. A lot of people use tools, that are more or less contemporary. Also, we are seeing other factors that, hello? So we're also seeing other factors that were not typically applied previously, and that was the impact of certain trends, such as ESG, as has been mentioned earlier today, and how the sustainability factors of a property would affect its attractiveness to occupants and then to would-be investors in the future. So that has become more and more prevalent. As a publicly listed company, UPDC is required now to disclose its sustainability strategies in all our annual reports. And I think this is one of the inputs that FRC and some other regulators have now instilled. And that shows the importance of reporting your ESG credentials as a company, and that flows all the way also to your properties as such. Recently, we've also started seeing the implementation of indexation, and that's something that perhaps we will delve into further today, because we are seeing a constant erosion of value in real terms when we look at the valuation of our assets compared to international benchmarks. When we have a rapidly devaluing currency, then you realize that the rate of devaluation of the currency is probably not commensurate with the rate of appreciation of your assets in local currency. So many practitioners, and we have also started looking at that seriously, about indexing value, not just to local currency comparables, but to test the real value of assets by also comparing it with international indexes and benchmarks. If we say that real estate is truly a hedge against inflation, then it should behave as such. And we shouldn't see a situation where, as inflation is exceeding 30% in Nigeria, we are seeing real estate values not moving across in the same leaps and bounds. Obviously, this doesn't apply to every asset, but today we are talking about investment. So these are some of the issues that we'll probably want to address today. Thank you.
Thank you very much, Mr. Ojo. You've touched on some areas that I'm still going to ask questions on. Because of this thing at my back that is actually timing whatever time we are spending here, I think we should try as much as possible to spend no more than 2 or 3 minutes in answering each of the questions. Thank you. Mr. Eniche, let me come to you. In recent time, we've seen economic shifts, and we've equally seen policy changes which have impacted valuation in Nigeria. Can you please tell us what the impact of currency devaluation and higher inflation on yields are on valuation?
Okay, thank you very much. Once again, thank you all the participants for being here. I'm honored to be before you making this presentation or being on this panel. Again, I come from the perspective of a banker, so you'll forgive me if some of the things I'm saying are out of sync. But the reality is that indeed there have been significant changes, seismic changes across the landscape. For a banker, when you come to us, say to invest in your project, provide financing, of course, some of the things we're looking at, things like loan to value, and then of course, mitigating our own risk, and also the portfolio that the bank holds, a number of things are very significant. Indeed, it is true that with inflation, and just to also add to what Mr. Ojo said, it's not just the fact that the property rates are not catching up or the capitalization rates are not catching up, but the fact that even the purchasing power of the buyers are being eroded. And for us, really and truly, when you come to us and we want to take your property as collateral, for instance, what is most important to me as a banker is, under a forced sale scenario, what can I recover? So what is my coverage? So in that sense, the impact of inflation, the impact of devaluation is significant. And we saw this come to play, especially when we had given foreign currency loans to customers that had given us collateral, which are essentially denominated in Naira. And now with the devaluation, I mean, you can just imagine. So it is significant. And I hear you, sir, when you say we need to start considering things like indexing. But the reality is that value is only as good as what the market will pay for it. So for me, yes, there are several ways of doing valuation, but really it will be comparable sales that is most acceptable to a banker at the point of lending and looking at it as a collateral, because if the loan fails and I were to put this property in the market, what can it command? Thank you.
Thank you very much for that wonderful response to the question. The next question will be directed to Ben. And the question has to do with the fact that from an international perspective, what are some of the trends with respect to valuation, methodologies following COVID, higher inflation and energy costs? Ben.
Thank you for the question, and sorry to be looking over your shoulder behind you. I can see you on the screen, and I'm a little bit out of proportion to the others, so great to be with you, and thank you for the invitation. Looking at a global level, I think it's probably really important that we understand that a valuation should be a story. It should tell a story from the beginning to the end. And that's the basis of both the Red Book and the International Valuation Standards, is to set out the processes for carrying out the valuation so that the recipient of the valuation can understand the story. And particularly, as you mentioned earlier on about data changes in technology, there is a danger that actually that starts to impinge on the story, so we need to make sure that the value is telling that complete story from beginning to end, and where they're relying on other sources of information to come to their conclusions. We undertook a review of investment valuation in the UK. We say we, the RICS, undertook a review of investment valuation in the UK because there were beginning to be some concerns about the reliability of valuations in the UK investment market. Fortunately, the review didn't find any systemic problems in that area, but it looked at how we could improve the trust and independence of valuations. And so, for example, in the UK market, we've recently introduced a rotation requirement for valuers, so that one valuer can't undertake investment valuations of an asset for greater than 5 years. That same process that was introduced to the accounting profession a number of years ago. So making sure that the valuations are transparent. But one of the main recommendations from that review was that valuers should, where possible, use the investment method of valuation to come to their conclusions for investment purposes. But we have pushed back and sort of said it is still the professional decision of the valuer to select the appropriate approach to valuation, and that will depend on the data that is available in the marketplace. The big concern that we have that you need to be careful of is if you are using the investment method of valuation, that you don't mark to model rather than mark to market. As my co-panelists have already indicated, it's the market which drives those decisions and identifies the risk. So what the valuer should be doing is helping to identify those risks and coming with the information which helps the decision to be made that is in question. And that's been happening globally. And one of the challenges is perhaps where a company with real estate, tangible asset investments, where their share prices are considerably off the net average values of the assets which are being held by that company. And that leads to some mistrust in the marketplace. And there are very often reasons for that discrepancy. If you squeeze an illiquid asset like real estate into a liquid fund that is traded on the stock exchange, and then when the markets turn, it shouldn't be a surprise that actually there's a disparity between the company share price and the actual assets which are held by that company, because of that liquidity issue and the changes in the marketplace, the inflation, the changes in interest rates, which impact on all of those challenges. That's probably quite a long-winded answer. I'll stop there and see whether there's any come back in the questions later on.
Thank you.
Thank you.
Thank you very much, Ben. You touched on something which is reliability of data. My next question, I'm going to direct it to Mr. Ojo, and it has to do with data for valuation. So the question is, what are some of the challenges you face in determining if you are obtaining accurate and reliable data for property valuation in Nigeria? That is one part of the question. The other part is, how reliable do you believe the valuation you are receiving are?
As a result of that, the credibility of the data that we receive have to be critically cleaned up and scrutinized before they are applied. The good news is that we now have some independent service providers who are actually rendering that as a service, and they are providing more and more data points for the market to use. Also, estate surveyors and valuers have been very useful because they are almost like a funnel, for this data mining to happen. And to answer your next question around our comfort level with the reports that we receive. So we are very, very careful about the service providers we engage. And that is where the difference is. You need to go to tried and tested and experienced service providers that over the years have held their credibility and they will maintain their integrity. So I believe we still have very credible practitioners in this market, and for all the valuations that we have done, we have been very satisfied.
Thank you very much for that. Ben, let me come back to you, still on reliability of data, and taking it from where you stopped. What challenges do you see in other jurisdictions with respect to reliability of data and accurate valuations? What lessons do you think users of Nigeria valuation can learn from this?
Yeah, good question. Again, the reliability of data depends on how it's mined, how it's captured, how it's cleaned. I think one of the major things that has changed in the valuation field is that valuations are now audited at a number of stages, as some of the panelists have already indicated. Whereas perhaps when I was a lot younger, the valuation or the opinion of the valuer was the final number. But then having it scrutinised by various other auditing processes actually can cleanse some of the data which is then used in the marketplace. I see that as a very positive input. And the new international valuation standards have a requirement now for how you, for challenge and review of the valuation. And that data process is really important. But again, as Chris Thorne pointed out earlier on, real estate is such a diverse investment commodity. It's not just the real estate itself, but it's the tenants, it's the clauses which might be within a lease, and that whole process is affects the actual data, so it makes it very, very difficult to mine. But what we should be seeing in the valuation is an explanation about how that data is being used and any adjustments that might be made to the data which is being used. And also I see data in some of the, it's a horrible phrase, but big data, I think is quite a useful tool to check some of the other data which is being put into evaluation. So do they come to about the same conclusions, or are there some differences? But again, it varies in which country you are, and Nigeria, you've got and I commend you for the introduction of the international valuation standards and the ESVARON process and the Green Book. And this leads to a consistent language which is then used, which helps to drive that consistency of data. That's something that we've seen in more mature markets. As investors come into those markets, they demand that clarity around the data and the data which is being used. And if you want to reduce the risk, you need to start to provide that data which is then relied on by the clients. It's not easy. Valuation is not supposed to be easy. I quite often say that it's a bit, being a valuer is a bit like being Sherlock Holmes, that you have to go into the marketplace, you have to find the data, you then use that data, and you might get called up in a court of law to justify why you've used that data. So valuation is not easy, but it's a really strong profession that we need to encourage. So again, I'll be quiet at that point.
Thank you very much, Ben, for that wonderful response. Mr. Eniche, permit me to come back to you. You are a risk management person, and you are the best person to deal with this question. What are the risks and uncertainties you see in the market today? What do you expect from your valuers and in their reporting in assessing these risks and translating them into sound valuation that you can use as a property developer or as a lender?
Okay, again, I think some of the risks Mr. Ojo had spoken to, which is the lack of transparency, especially with regards to valuing for different purposes. You would do a certain valuation to report in the books, you do a certain valuation for your tax purposes, you do a certain valuation to report for the purposes of paying your taxes on any transaction. So all these things introduce some measure of opacity in the market. Now for us in Wema Bank, what we've tried to do is to work with very reliable partners, and I'm happy to say that D.R. Fatimile is one of those, the few valuation firms that we work with, and over time they've been able to give us reliable reports. But I've heard something which is very important, and I think it's something that, just like in the audit area, which you do not allow a particular audit partner to audit a bank for 10 years, in the same way you would look at rotating that. Secondly, and I don't know if this is the practice, but valuation reports should be indexed. So today, if I'm looking for a valuation report on a particular property that was done 10 years ago, I don't need to go back to that company. What I'm saying is that maybe the Estate Valuation Society, yes, I know that issues of privacy and whatnot, but they can be anonymized and indexed. So today we have a regulator called the CBN, Whichever loan you give in Nigeria today, for whatever purpose, across the banking industry, you would find that record in CBN. Nobody else can have access to it, but if a case arose where you need to approach and get that figure, so I don't know, maybe this is something that the valuation industry should consider, because you need reliable data, and it is coming off the back of this data that you can begin to do analytics, use big data. So we do not have that trend over time to actually make reliable decisions on a going forward basis. One of the other things, of course, we all live in Lagos. Over the last couple of days with the floods and whatnot, there are areas that are prone to flooding. Some of these areas, even the valuation of those properties in that area should be impacted. And that is where when we talk about the ESG figures and whatnot, so what do you do, and how is that now going to be incorporated on a going forward basis into the values of those properties?
Social and governance factors being incorporated into property valuation globally.
Sorry, was that directed at me? I didn't quite catch that. It didn't come through, if that was directed towards me.
Oh, okay, sorry. How are environmental, social, and governance factors being incorporated into property valuation globally?
That's again a great question. As Chris indicated earlier on, the international valuation standards now have requirements relating to ESG considerations throughout their standards. And the new Red Book, which is out for consultation at the moment, so please, I'd encourage everybody to look at the RICS website and feedback on the amendments which we're proposing to the Global Red Book. But there are approximately 57 mentions of ESG throughout the Red Book. So the valuers need to understand those challenges about climate resistance, the flooding issues that were mentioned, and really taking those processes into account when they are looking at the comparable evidence that they are using for the valuation. So it's not just looking at the property, the piece of real estate that they are valuing. They need to understand, the valuer needs to understand whether the comparable evidence they're using has been impacted or not impacted by environmental issues. I think one of the biggest challenges, and again across to the accounting profession and the valuation profession, where we need to make sure that we're absolutely joined up, is that many of the financial reporting regulations regarding ESG are at an entity level, at the company level, at the organisation level. But most of the valuation issues that tangible asset valuers are getting involved in are at the individual property level. And so how those ESG requirements get pushed up into the entity level or accumulated into the entity level is going to be really, really important to make sure that we don't double count in places or create gaps. So that dialogue between the accountant and the profession is really important. And probably the only other thing I would add, and I guess this is a cautionary tale, is that one of the things that I see quite often globally is a valuation which has been commissioned for one purpose suddenly appearing into financial accounts for financial reporting obligations. So, which is obviously incorrect, and we need to make sure that the valuation is being used for the intended purpose, as the international valuations now refer to. So making sure that it's a valuation for the purpose is a critical part of making sure all the numbers add up into a proper reporting structure. I hope that answers that question, but would be pleased to hear others' comments if there are any.
Yes, thank you very much. You did well on that. Before I leave this question, ESG is a global thing. Back home in Nigeria about 2 years ago, we have a law that was passed relating to climate change. From the financial reporting point of view, we have FRC that released a roadmap that shows how Nigerian entities will adopt the sustainability reporting standards, S1, S2. Those are the two that have been issued now. Mr. Eneche, you work for a lender. Do you really consider this when you are making your decision to lend?
Absolutely. Maybe more so in terms of the manufacturing firms and other people doing real estate. When we look at real estate projects, we're looking at things like how they're sustainable in terms of do they have green energy, and we are going to that point where we are actually incentivizing developers to apply certain green energy, say in their real estate development. So we have a customer that came to us recently and had requested for a facility specifically to do some residential homes. But luckily, we have some provider, also a financier, that had given us some very good loans at very low rates, which I won't mention here. But we were able to extend the facility to him to enable those homes to also have some solar energy. So those kind of projects are things that I think in the future, a lot more developers will be looking at things like that, because apart from the fact that it makes business sense, it also provides value to the economy.
Thank you. Thank you very much. I move to the next question, and this is for Mr. Ojo. The use of technology. Is technology impacting the valuation process in Nigeria? That's one part of the question. Are there tools or software that you believe that can be adopted and will become industry standard when it comes to valuation?
So the short answer is yes. Technology is disrupting every single aspect of human enterprise. That's the short answer. And valuation is not an exception. And I believe that valuers also are beginning to retool and are beginning to change the way in which valuation is being practiced. The practice of valuation is being done. So technology impacts valuation in several ways. First and foremost, the access to data is being enhanced by technology. Right from your system, you can do a lot of search, on the internet. You can aggregate more data because there's technology. And that improves the output of valuation. Whereas in the past, you had to pick up the phone and call 3, 4, 5, 6, 7 people for comparables. Right now, through technology, you can aggregate thousands of transactions. So to that extent, I believe we're getting better and better at determining true market sentiments via technology. Also, in terms of tools, crunching of big data and ability to make very complex calculations, things like discounted cash flow systems, such calculations can easily be done via technology. And since we are looking at investment based valuation, that's a critical aspect of it. Also, in determining factors like discounting factors and interest rates that also impact value, technology is also making it possible to benchmark either through different portals, CBN, banks, and so on, can give you a lot of information. Just being able to have access to a lot of information to aid your valuation is very, very important aspect of technology. In terms of whether there are tools, there are so many valuation softwares out there. Obviously, as a valuer, I would also advise that they are just tools. A tool is just a tool. The valuer is the person who applies the judgment. And there's a lot of judgment to be made when valuation aspects are being considered. As has been said today, environmental factors, human sentiments, even cultural and religious sentiments can all play a very big role in valuation outputs. But technology definitely is helping.
Thank you very much. And I love the part you emphasize. Tools are just tools. The valuers are the ones doing the main show. So we should not forget that. We are moving close to the last question now. And the next question goes to Ben. Ben, so be ready to take this. Do you think that valuers need to do more to ensure they understand the basis or purpose of valuation they are undertaking? What can valuers do to ensure they and their clients understand what basis should apply?
Yeah, thank you. And again, I touched on this on the last response as well. The intended purpose of the valuation is really important because that drives the basis of value. And again, Chris talked about this earlier on, that market value and fair value might be very close in numbers, but actually they're very different requirements of the valuer to verify the information which has gone into the valuation. So the process of understanding the various bases of value which are contained within the International Valuation Standards and the Green Book and the Red Book, it's really great that those are consistent and that we don't create slightly different definitions which then create further confusion within the marketplace. But it's really important that the valuer helps the client. RICS are just drafting a product to help the client who are commissioning investment valuations to understand the process. But it's incumbent on the valuer to engage in that conversation to make sure that the client understands the purpose of the valuation. And you have to remember there are a wide variety of clients, some extremely well versed and educated in the processes, but there are also clients out there who aren't, where valuation is not their speciality, accounting is not their speciality, and therefore the valuer has that role to help ensure that the appropriate basis of value, whether it's market value, investment value, synergistic value, fair value, are understood, and the relevant data is then collected and applied to an appropriate model. And I think just going back to the responses of from the panel on the last couple of questions, it's really important that the approach is the appropriate one, and we've got three main approaches which are identified within the International Valuation Standards: the comparable approach, market approach, the income approach, and the cost approach. And when data starts to get scarce, there is a tendency to move to the cost approach, but it sometimes is forgotten that actually that cost approach is still trying to get to the basis of value that has been chosen. So if you're trying to get to market value, the cost approach is an attempt to get to market value. It's not just the cost of reproducing. So again, the valuer has that role to help articulate that into their valuation report. But I also see as the major part, it sometimes gets skipped over, is the terms of engagement and how important it is to make sure that those terms of engagement are robust and appropriate, because that starts to drive the whole process of valuation, in that the valuation instructions identify the purpose of the valuation, the basis of valuation, the valuer then applies their judgment, has been already articulated, and creates the report. But the report should mirror the the instructions which were created at the beginning. So it creates this quality circle to be able to identify that each step of the process has been undertaken appropriately. So that instruction part is really, really important.
Thank you very much. Thank you, Ben. I know our time is up, but there is a question here that has been directed to me. As a moderator, I'm not supposed to answer questions, but by virtue of not being a valuer, of being an auditor, a financial reporting person, I believe this question can only be answered by me here. And the question is, what are some of the disclosures you expect to see in valuation reporting, especially given the IFRS standards which apply to financial reporting in Nigeria? Let me quickly answer this in 2 minutes. As since 2012 in Nigeria, Nigeria has adopted IFRS as a reporting framework, right? And as a result of that, what I said earlier on when I was doing the introduction was the fact that the output of your work as valuation expert becomes the input into the financial statement preparation. Accountants are responsible for preparing financial statements. And at the end of the day, another gatekeeper, auditors like us, come in to audit the financial statement, right? Based on the requirement of accounting standards, Chris touched on some of these things earlier on. If you carry maybe land and building in your book as part of property, plant, and equipment, oftentimes in this part of the world, it's only land and building that are often carried at fair value. So you need a valuation expert to be able to help you in doing that valuation. If you carry land and building as investment property, you have to do and you are using fair value model, you have to do the valuation at the end of every reporting period. For banks, CBN has prevented them from carrying their property, plant, and equipment at fair value. But for insurance company, what NICOM requires is that they need to use fair value model. If you carry investment property in your book and you fair value it, the fair value gain or loss, it goes to your income statement. It forms part of the profit that you distribute at the end of the day as part of dividend. That shows the importance of the work you do and the work we do as external auditors as well. For that purpose, IFRS 13 that Chris was referring to the other time has a number of requirements, especially when it comes to items carried at fair value that are classified at level 3 of fair value hierarchy. Globally, even in the developed markets and in Nigeria, when it comes to valuation of tangible assets, they are usually categorized as level 3. There are 3 levels in fair value hierarchy in accounting standard, level 1, level 2, level 3. But when it comes to tangible assets, they are often classified as level 3. And when it comes to level 3, because the inputs that have impact on valuation, they are usually unobservable. A number of disclosures are required, a number of them. Experience has shown that when we get valuation report from some of our clients to review, either as investment property, either as property, plant, and equipment, or what Chris referred to, not current asset held for sale, that you are just classifying as held for sale at a point in time. There are certain disclosures you need to make. For example, these disclosures include, there are some of them that it is the reporting entity that will make those disclosures, but there are some that must come from the valuation expert. Some that must come from valuation experts include the description of the valuation technique that has been used. We've been told under IFRS 13 there are 3 valuation approaches: the income approach, the market approach, and the cost approach. So whichever approach you have used should fall within those 3. Input used in the valuation technique should be disclosed in the valuation report, or else the company will find it difficult to disclose those things, and auditors will always raise issue. Quantitative information about significant unobservable inputs. Those inputs you have used that are unobservable, there are some quantitative disclosures you need to make about them. The narrative description about sensitivity of changes in those unobservable inputs, you need to equally disclose them. And when it comes to IFRS 13, when you are valuing tangible assets, which are non-financial assets, there is this concept called highest and best use. Highest and best use means the use to which you are putting that asset should be the use that actually is going to give you the maximum value. So again, there are specific disclosures that you need to make around this. I just believe I should highlight this quickly. I know there's another session dealing with financial reporting. At this juncture, I would like to thank all the speakers at this panel, starting from Mr. Ojo, Mr. Ineche, and Ben. Thank you very much for the wonderful work you have done. Thank you.
I think our applause should be multiplied to the power of 4. One for each of our, please don't go, we're still going to take questions. To the power of 4, that's to the power of 2. So 2 more levels to go. Thank you very much. That was excellent quality of discourse going on right there. I learned so much. You know, I kept looking at the timer, and I was saying to myself, I wish there was a way we could hold down this timer so that time would not go, because I was learning so much. But you know, time being what it is, nobody can stop time. So again, I'd like to say thank you very much to our panelists and to our wonderful moderator. Thank you very much. I'm sure we have questions. We'll take a few questions. We'll take questions also from our participants online. But if there are any questions in the room, okay, I see one hand. Any other one? Let's indicate so we'll know how many questions we're taking because of our time. I see one hand. Any other question? Do we have any questions online? If we do, please pass. Okay, number 2. I see 2 hands. I think that's fair. We have one from the left, we have one from the right. I think that's fair. So we'll take 2 questions. So the first question, the gentleman, could you please pass the microphone to him? Please indicate, sir. Right here. All right. You know, while we're passing the microphone to the first gentleman to ask the question, I have a question for the panel, but you don't have to answer now, you know, but maybe it's just something, food for thought. You know, as the session was going on and the power kept fluctuating, so I said to myself, do we think it's about time that we call on Dia Fatimileye and Co. to do an evaluation of the discos that we have? Maybe it's time to evaluate the plant and machinery and the equipment of the discos that we have in Nigeria and see why we keep having this fluctuation in power. But that's not a question for you to answer now, maybe just to think about it. All right, thank you very much. Your question, sir. Please go ahead.
Good morning, everyone. Thank you very much for to the panelists for the contributions they've made. My question comes from the last contribution from the moderator, which was you got everybody listening. 2 points I have. First is this fair value issue. It's a major confusion, particularly in our market. Nobody is asking for a fair value valuation. Every time it's market value or open market value. So we get confused. You stress so much on fair value. Fair value in this, and you speak from an accounting point of view, because I know fair value is what accountants talk about. But we valuers, we speak about open market value. And Chris has said it's the same thing. We need to agree today what it is. I think we will go out today knowing exactly what we've picked from this session. The second thing is the highest and best use. Again, I am very clear the highest and best use is a US accounting word. For them, the land value or a property value is equal to the highest and best utilization. That is optimization of land. But for us, coming from the other side, which is the UK and Europe side, we look at different ways of getting the valuation, which is again is the market value. So in the US, it's highest and best use. For us on this side, it's market value. For you accountants, it's fair value. And you've used the 3 words in trying to tell us what we need to do. We are still confused. So please, let us have an agreement today before we go. Thank you very much.
Okay, thank you very much. Your questions are 2 in 1. The first question has to do with confusion created by the fact that we accountants refer to fair value. You valuation expert, you refer to open market value or market value. What we've even seen in the reports that we've always received when it comes to valuation of tangible assets is we see two values there oftentimes, open market value and false sales value. And there's been a debate as to the fair value that IFRS 13 refers to. Which of those two? There is a school of thought that says the fair value of IFRS 13 lies in between the two. It's neither the open market value nor the false sales value. Fair value as defined by IFRS 13 is the price that will be received to sell an asset or paid to transfer a liability in an orderly market between market participants at the measurement date. So looking at it from that point of view, I know proud to the global credit crisis, individual accounting standard has definition of fair value, which is the same. It was after the global credit crisis that they were able to issue that IFRS 13, which became effective in 2013. We don't talk of market value. We don't talk of open market value. But what IFRS 13 is not a valuation methodology. That is why we have valuation methodology or standards being issued by a body similar to RICS, as well as International Valuation Standard Committee, Council. That is, IFRS 13 is not a valuation methodology. However, as already alluded to when I started, that valuation can be done for many purposes. But when you are doing valuation for financial reporting, you need to obey the requirements of IFRS 13, and it is fair value. When you begin to unpack that definition, you look at, it talks, fair value is an exit price, not an entry price. Entry price is different from exit price. It must consider market participants. It must consider the fact that the participants in the market, they are independent of each other. They have ability to enter into the market. None of them can coerce each other. When you talk of that false sales value, that is why people question it, because it doesn't meet the definition of fair value. So my own advice is that when you are doing valuation for financial reporting purposes, just like when it comes to actuary, an actuary does valuation of employee benefit, right? But when it's doing it for financial reporting purposes, it must comply with the requirement of IAS 19. There's an accounting standard that deals with that. So likewise, when you are doing valuation for financial reporting purposes, you must obey the requirements of IFRS 13. Otherwise, what you are doing may fair value of IFRS 13 may lie in between the two. Highest and best use, he said, is a US concept. Yes, I think Chris touched on this. It took us the memory lane of how they came about the IFRS 13 and the fact that the US standard setter, which is the FASB, worked closely with the IFRS standard setter, which is the IASB. Unfortunately, this concept is there in IFRS 13, and it only applies to non-financial assets, of which all tangible assets we are talking about are part of it. But despite the fact that we have this concept there, it says that there are certain things you need to still consider when you are looking at highest and best use. You must consider a use that is fiscally possible, legally permissible, and the third one I've forgotten. But there are three key considerations that you need to give attention to when you are looking at this concept. Like I've said before, when you are doing that valuation, then you still need to obey the requirements of IFRS 13. Thank you.
Thank you, Ma. I want to appreciate the Fatima Lane for this opportunity given to us. I'm Dr. Adeyemi Adeni. I'm representing the president of Real Estate Developers Association of Nigeria. And I also privileged to be the chairman of Developers Association of Nigeria Ogun State chapter. My questions are interwoven, and it will come to you, sir, Mr. Neche. You know what we're facing, not just as a country, but even globally. The question has to do with what we are going through in the area of inflation. The first question is, you withheld the name of the lender that was actually giving facility at a very reduced rate. It will help us a great deal because virtually all of our developers, many people are crying right now considering so many things that cannot be spoken about that we're going through, even in the nation, even aside inflation, the place of land grabbing and demolition and so on and so forth. Right. Most of us rely on off-plan for survival using the OPM model. But fortunately, within 3 months, even when we have bill of quantities, even 1 month, within 1 month, it's expired already. It's not workable again. By the time you even move to site, you've collected funds from people, you want to build genuinely. Many people who set out even to build legacies, they end up being fraudulent, and which they never planned to do. But the state of the economy has done that. Now, we want to stock up, but you need money to also stock up also in order to be able to say, okay, this is all we need to complete this project. But labor cannot be stored, and so on and so forth. So what will be your counsel to us to be able to come out of this? Because I keep telling our developers now, you can't rely on the other people's money theory, plus the fact that you want to move to site and do off plan. You collect 100 million. By the time you're building, you end up using about 120 million. And most clients are not willing to comply and come to terms to do an addition, because there are some strict agreements or contracts that bind the two of you, and they lock it up now. So what's your counsel, and will you be willing to release to us the name of the lender? Thank you.
You are trying to ask me to give you my trade secrets. Well, let me just say that indeed it's a trying time for developers, and you need a financial partner that understands. Not here to publicize my bank, but indeed, Wema Bank is one of the better kept secrets in the banking industry. You need a partner that will work with you through this. But even from the conceptualization of your project, your target market, looking at their capacity to repay, and if the need arises for you to stretch that repayment over time. And I'll share with you one particular example. When we knew that inflation was galloping, we saw it all coming, that CBN continued to restrict money supply, and that meant, you sit down every month, every other month, and you see that the CBN's rates are going up, the MPR rates, you will know that commercial rates will go up also. A customer approached us and said, I need to stock up. I need to pay for the cement now, I need to buy the iron rods and whatnot. You would do that. But also with regards to the kind of contracts you enter with your off-takers. So some of them, already you have bank guarantees. On the back of that bank guarantee, you can come to your lender and say, okay, I want to pledge these guarantees and take some money to buy these goods. To buy project within scope, right? Within the cost and the scope. It is true, however, that from time to time, you might find out that you are underwater. But it's important that you move swiftly. One of the challenges we find is that a developer wants to move at his own pace, and he doesn't want to do it in a way that it is really and truly project managed. Often you have to separate the conceptualization from the actualization. So you might be the developer that has come up with this idea, but let it go through proper project management. You might need to employ a third party to deliver. So other than that, we can sit down, have a discussion, and definitely it's something that we've seen people go through the stress, but we've also seen people make success of it.
Thank you very much. Thank you very much, sir. In the interest of our time, I don't think we have any other questions. Is there any question online? Maybe we can take one if there is. Otherwise, I think, gentleman,
I
please.
think Basharun has a question also.
Oh, sir, do you have a question? Okay, okay. So
Hello?
we'll take those two more questions.
Okay, my name is Kingsley. It's not actually a question. I just want to comment to what the EY man said. When you said when we do valuation for financial purpose, most of the time we don't include a mortgage for sale value. So I think that is where the confusion is. When we do a valuation for financial purpose, most of the time we don't include for sale value. For sale value is, in most cases, when we are doing valuation for secured lending or for mortgage. And that is when we are sending it to Mr. Enenche. I think Mr. Enenche will know what I'm saying. So when we do for financial reporting, we don't, for sale value there is not for financial reporting. That's just what I want to comment on. Thank you.
Thank you very much. I just want to know the current attitude to valuation surplus on property, plant, and equipment. I know in the past, a percentage is usually taken and carried to capital reserve. I want to know whether it's now taken at 100%, whether to capital reserve or to shareholders fund. Thank you very much. I think that question is to the moderator.
Okay. Thank you very much, sir.
Okay. Oh, I'm sorry. I just want to interrupt you. All valuation at exit level, because it's a theoretical position at what a willing buyer or a willing seller is at exit. The only difference when you talk of for sale value is now being forced with limited time. So the timing is what determines it. So the exposure you can give it to the sale process is lower. So that's why it's at a discount, because we need to attract people at that kind of discount, depending on what type of property it is. If it is industrial property, the discount may be as much as 50%. But if it's a property at Victoria Land, which has copious market, the discount may not be more than 5%. So it depends. So, but valuation in essence of it is at the exit point. So, how do you now pick the fair value?
Okay, I think there is a need for further discussion on this. But to quickly answer the question you asked, sir, since we moved to IFRS regime in 2012, under IFRS, when you fair value property, plant, and equipment, and you have a revaluation gain, if it's a revaluation gain for the first time, there's something we call other comprehensive income. From there, it goes to revaluation reserve, fully, no discounting of any portion of it. But if it's a revaluation loss for the first time, then it goes to your top line, which is what we call income statement of profit or loss. And that forms part of the profit for the year. So it reduces the profit for the year if it's a loss for the first time. If it's a gain for the first time, it goes to what we call other comprehensive income. From there, it goes to revaluation reserve. However, the reason I mentioned that for banks, CBN prevented banks from using revaluation model, from fair valuing their property, plant, and equipment, is that CBN has done that indirectly, not directly. In what sense? In the prudential guideline, there is a clause there that when you revalue your asset, if you say you should discount the value. When you discount that value, assuming you arrive at 100 million, you should discount it by an amount to a lower amount. You cannot comply with that CBN requirement and comply with IFRS. Because the moment you discount the value, you are no longer complying with IFRS. So indirectly, CBN prevents the bank from using revaluation model when it comes to their property, plant, and equipment. And that is the only sector where that is applicable. Other than that, it's not applicable under IFRS. Thank you.
Thank you very much. Thank you very much. Can we give a round of applause again to our panelists and to our moderator for a wonderful job well done. I'd like to say a big thank you to you, Mr. Ben Elder. Thank you very much for your time. Mr. Silvanos Eneche, thank you very much, sir. Mr. Oduayo Ojo, thank you very much. And to our well-able moderator and panelist, Mr. Jamiu Adeyemi Olakison, thank you very much. Can we just appreciate them again? Thank you very much. Thank you very much. Yes, thank you. We'll be taking a break for tea now. It will be a very short break so that we can catch up on our time. I hope we can do that in 15 minutes. We're not done. We're just halfway through. And I can assure you that the next panel will even be just as engaging and as enlightening as the first one we've had. So we're going to take a short break for tea now. Right, okay. Okay, beautiful. So we'll take a short break for tea. Thank you again to our panelists and to our moderator. For our speakers and the people on the front row, just for the, to make our transition into the tea break very seamless, please let's have the people on the front row, our speakers and the people on the front row, to follow the gentleman raising his hand up. Please follow the gentleman with his hand up, all our panelists and speakers and our invited guests on the first row. The rest of us will just, the adjoining room right behind you, through that narrow door, please just go in and then we'll take our tea very quickly. In the next 15 minutes, we should be back at the hall so that we can catch up for time. Thank you very much. We're not done. We're coming back in 15 minutes to continue this wonderful seminar. Thank you very much. Enjoy your tea.
Join us for the prestigious Business Day CEO Forum 2024, themed Leadership in Tough Economic Times, featuring renowned speakers including Olayemi Cardoso, Governor of the Central Bank of Nigeria, Catherine Dugan, Dean of the Business School at Cape Town University, South Africa, and Patrick Njoroge, former Governor of the Central Bank of Kenya. Date, Thursday, July 11th, 2024. Time, 9 a.m. to 4 p.m. Venue, Balmoral Hall, Federal Palace Hotel, Victoria Island, Lagos. Don't miss out on this opportunity to network, gain insights, and drive results at the Business Day CEO Forum 2024. Register now and secure your seat among industry elites. See you there.
Okay, please let's round up on tea. The session will be reconvening in the next 3 minutes. Let's wrap up on tea break, please. Please, let's begin to make our way back into the hall. Let's make our way back into the hall to continue with the next session. Okay. Can we please come back into the hall now? Can we all come back into the hall now to continue with the session? Thank you very much. Let's make our way back into the hall now. Okay, please let's just settle down as we proceed into the next session. Can we just take 1 or 2 minutes to settle down, please? Okay, thank you very much, distinguished participants, ladies and gentlemen, thank you. Can we please settle down as we move into the session? We're gradually moving towards the end of the seminar, so please, in an hour or so, we should be done. Please, let's settle down. Can we please settle down? Thank you. Okay. So we're moving right to the next panel discussion. As we know, we have 2 panel discussions for today. We just concluded the first one before we went on a break for tea, and now we'll be going into the second one. But before we do that, we have a question from our participants online, and we don't want to leave online participants out. So we'll take a couple of minutes to quickly address that question, and then we'll go ahead into the second panel discussion. So I'm going to direct this question to, I think I'll direct this question to Mr. Odunayo Ojo. Is Mr. Odunayo Ojo there? Okay. Sir, please prepare to take this question. There was a question online, and the question goes thus. Can we please make arrangements to pass a microphone to Mr. Odunayo Ojo so that he can answer this question? The question goes thus, sir. How often should valuation for financial reporting be concluded in a volatile market like Nigeria? That's the question for you, sir. Can we have a microphone? Thank you. How often should valuation for financial reporting be concluded in a volatile market like Nigeria?
Thank you. Thank you for that question. So, depending on the type of asset. So usually as a property company, we have 2 types of assets that we effectively hold. The first one is investment properties. So that's property that effectively we hold for income. And then we have properties that we call inventory. That is properties that we want to use for development in the normal day-to-day part of our business. Because we are developers, we have properties like landed properties mostly, where we intend to develop and sell to third party. So for investment properties, we normally advise that the valuation is done yearly, because at the end of the year, you need to include that in your financial statements. They form part of your balance sheet. But for inventory, because the market is moving very rapidly, we have now seen situations where valuations can even be done every 6 months. You know, so that the replacement value of your property can be constantly renewed. Otherwise, you will realize that you are selling your property at below market. We are seeing, especially with land, and if you look at landed property along high growth areas like Lekki Ekpe Expressway, there are certain sections of that corridor where values are changing every quarter because of high demand. See people coming in there and they demand properties very frequently. So as a developer, if you do not revalue your inventory, as frequently as the market is moving, your pricing model might be incomplete. Thank you.
Thank you very much, sir. Thank you very much. So to that question from our online participant, I hope you've gotten the answer. Thank you very much, Mr. Odoayo Ojo. So we're moving right to the next panel discussion. And to discuss in this panel, we have three very versed professionals in their field. We have Mr. Christon. Mr. Christon is not a stranger to us. He was the one that had the fireside chat with the founding partner of Dear Fatimile & Co. just earlier on today in the morning. So Mr. Christon, you're welcome once again. You're welcome to this second panel discussion. Also joining him on the panel, we have Mr. Jamiu Adeyemi Olakison. Again, Mr. Jamiu needs no further introduction. Okay, so he was the moderator on the first panel, but we can welcome him to the podium. Please, let's welcome him. So this time he's not moderating. This time he's a discussant. You're welcome. Thank you very much. And joining them, we have, to sit on the panel, we have Mr. Olamide Obajimi. Mr. Olamide Obajimi is a partner with Olaniwu Ajayi & Co. He is a senior associate in the firm's tax practice group with extensive experience in corporate business structuring, tax compliance, advisory planning, litigation, and cross-border tax structuring. Yes. He specializes in international tax and transfer pricing and supports clients during tax audits and investigations by federal and state authorities. A skilled tax facilitator, Mr. Olamide Obajimi played a key role in training officials on Nigeria's voluntary assets and incomes declaration schemes, the VADES, and contributed to the review of the Joint Tax Board syllabus for Nigerian tax officials. Please join me in welcoming to the platform this afternoon, Mr. Olamide Obajimi. You're welcome, sir. It's always good to have someone that knows a lot about tax, particularly in an environment such as Nigeria. So thank you very much. You're welcome. So to moderate this panel, it's my pleasure to call on Miss Uloma Ojima. Miss Uloma Ojima is a partner with PricewaterhouseCoopers, PwC, the Corporate Reporting Services, CRS team in Nigeria, and also supervises the PwC Nigeria Business School. She's an accredited member of the PwC Global Corporate Reporting Services team and specializes in the financial services and energy industries. She has been involved in providing accounting and financial reporting advisory services to several government entities and parastatals and has served on various regulatory industry working groups in dealing with topical financial reporting issues, including formulating, implementing guidance and advisory on new standards for practitioners within the industry. She has over 19 years of experience in providing assurance services and has been an IFRS technical expert for over 10 years. She's an accomplished chartered accountant with in-depth understanding of the FRS, having worked with clients across various sectors. Please join me in welcoming our moderator for this panel, Ms. Uloma Ojima. You're welcome. Please, you remember our agreement. The tea break has not nullified it. Please, let's keep clapping. Please take your seat. Thank you very much. Can we project Mr. Christon on the screen, please? Yeah. You're welcome, sir. All right. Over to you.
Hello? Hello? Okay, thank you, everybody. And it's been my pleasure to be here. It's been my pleasure to be here since morning, and it's been very insightful and engaging. I hope this session would provide further insights and deepen the conversations we've been having so far. So welcome to my distinguished panelists. So on this panel, we'll be discussing exploring best practices in financial reporting and compliance as it relates to valuation. You know, like the previous moderator,
my extinguished colleague Jami said during his session, the valuation reports you produce serve as an input into the financial reporting that is produced by the companies and, of course, eventually audited by the auditors. So in this session, we'll be looking at what are the best practices to ensure that the results of the hard work and the excellent work you do in the valuation translates, into accurate, transparent, and compliant reporting. Because at the end of the day, it is for the users of the financial statements. So we'll be exploring what would be useful for them in making investing decisions, and not just for the investors, even other stakeholders, in the business. You have the financial reporting regulators, you have the tax authorities, you have potential investors, current investors. All these people, they use the financial statements for different reasons. And when they see these tangible assets in the financial statements, they want to understand the basis by which those values have been derived. They want to understand things around potential future volatility on the values of those assets and how it would affect the future performance of the company. They want to understand the impact of these assets in the future, in the current and future earnings of the company. Because when you're looking at financial statements, you're interested in understanding the financial position and also the performance of the company. So you want to be sure that the values assigned to these assets would really translate to real realizable value, for the company, either through use or through sale of these assets. So under this panel, we'll be looking at understanding the financial reporting standards that guide the financial reports. So you have your set of standards that guide the valuation, but in doing your valuation, like the last panel also pointed out, you need to be considerate of the end use, which is the financial statements. There are also some sets of standards that guide both the valuation and then the reporting of the results of that valuation. So we'll be looking at understanding these standards and how it impacts the financial reporting. We'll also be looking at best practices. So aside from what may be explicitly required by the standards, we should also consider best practices in principle. You should also consider the realities of what is going on, in the economic environment where you are. Like the last question that was asked about frequency of valuation, and I like the angle that the extinguished MD of UPDC brought to it, that even though the standard might say value at least annually, but now we are in a situation of high inflationary environment, then some instances, if you are producing periodic reports, if things have changed from the last time you did evaluation, even though it may not be up to a year, you need to consider what this means for your financial statements. Do you need to do a revaluation at that point in time? And then we'll also consider compliance challenges with respect to financial reporting and valuation, and how to mitigate some of these, and also what the regulators expect, and also what we expect from the regulators in terms of streamlining the reporting of these valuation exercises. So I'll just go straight into the meat of it, and I would like to direct my first question to Jamil, which is more like the building block for this our discussion. And Jamil, I'd like to know, what are the key financial reporting requirements for tangible assets in terms of IFRS, because that is what is applicable for this jurisdiction. And then from your perspective, what would users of financial statements be interested to know or to see in the financial statements regarding the valuation of the tangible assets in the books?
Okay, thank you very much. This is a two-in-one question. Tangible asset is what we are talking about here. We are not talking of those assets that are not tangible. As earlier mentioned, tangible assets that are valued for financial reporting purposes can be classified into two, although there are others beyond these two. The first one is what you call property, plant, and equipment, which include land, building, motor vehicle, and what have you, that can be seen and touched. It's not mandatory that you carry them at fair value, right? But you have the option of carrying them at fair value, right? So as an entity, if you choose to carry them at fair value, which is those items that I've mentioned that you are not renting out, you are using it for yourself. In terms of frequency of revaluation, for property, plant, and equipment, it's not meant to be done every year. What the standard requires is it should be done as frequent as possible so that the value you carry in your book is not materially different from fair value. The standard says, for example, between 3 and 5 years. But again, we've said something now that may mean you have to do it more frequently. When it comes to the second type, which is investment property, that can only be land, building, or both of them together. That you are holding either for capital appreciation or for rental purposes, but you are not occupying it by yourself. In this case, the requirement is, if you are using cost model, of course, you are not going to fair value it for recording purposes. But for the purpose of disclosure, even when you are using cost model, you still need to disclose the fair value. Not many people know that, but we all need to be aware of that. But when you choose the option of fair value, right, it has to be done at the end of every reporting period. That is why we see insurance companies, like I've said earlier, because they are mandated by NICOM to use fair value model for their investment property, the evaluation has to be done at the end of every year. For investment property, fair value gain or loss go directly to your income statement. If you buy it for 100 million, you fair value at the end of the year for 150. That 50 million increase goes to your income statement. It forms part of your distributable profit that you can distribute to shareholders. But if it's the other way around, if it's a loss, it goes straight to P or L as well. It's only for property, plant, and equipment that is a bit different. And I think the response I provided to the question earlier asked suffices for that. Now, when it comes to disclosures, I've touched on some of the disclosure requirements that are very important to users. The valuation, okay, so earlier on a question was asked around the difference between fair value and market value. When we have an item that is traded in an active market, that market price is the same thing as fair value. But oftentimes this doesn't apply to tangible assets. When it comes to shares that are traded on NGS or bonds that are traded on FMDQ, those markets, as long as they are considered active markets as defined by the accounting standard, the prices obtained from those markets, even though they are called market prices, they are the same as fair value. But that is not the case when it comes to tangible assets. Because that market is not considered active, you need to use valuation techniques. We have market approach, income approach, and cost approach. Cost approach is the least recommended approach to be used. But at the end of the day, when you determine this, you must disclose the valuation techniques you've used, because users are interested in how you arrive at the fair value. For example, you bought this thing for 100 million, it has jumped to 150. They are interested in how you arrive at that. They are interested in the input. Considering the fact that those inputs are not likely to come from things that are observable in the market, so they are interested in all those disclosures. So some of the disclosures I've mentioned earlier, including sensitivity analysis of the changes when it comes to those unobservable inputs, they are part of those things that the users of financial statements are interested in. Thank you.
Okay, thank you, Jamil. Yes, and it's actually a very extensive list of disclosures which is prescribed in IFRS 13. So I think it would be helpful if you are doing your valuation for financial reporting purposes to liaise with the accountants to know which of those disclosure inputs they would require from the valuer. Thank you so much. So my next question will be directed at Chris, and this is twofold, Chris. So the first one is, what should valuers providing valuation include in their reports? Now, understanding that these reports are going as inputs into the financial statements, so can you just give us a summary, high-level summary of some of those inputs that should already be covered within the valuation report? And then can you also tell us more about the requirements, if there is any such requirement, and more about it, on whether valuers are required to approve the disclosures that are going to be put in the financial statements relating to the valuations they've done?
Okay, I'll answer those backwards if I may. Yes, certainly the RICS standards do require valuers to put into their terms of engagement when doing a valuation for financial reporting that their consent is obtained to any reference or disclosure of that valuation in the report. That's just to make sure that it's not presented in a way that's misleading to anybody reading the accounts. It's comparatively rare for the entire report to be included in the accounts. I mean, accounts are long enough now as they are under IFRS, and with valuation reports of a single significant commercial property often being 50-odd pages themselves, I think it's reasonable to expect there just to be a reference to or an extract which needs to be approved by the valuer. As to what goes into those reports, this is something which is not well observed by lots of valuers in my experience, who just seem to think that all they need to do is provide a number. IFRS 13, as we've heard, is quite clear that there needs to be clarity about how that number was arrived at in terms of indicating the method used and also the inputs used. And they perhaps need to be aware of what IFRS 13 says about the difference between observable and unobservable inputs, and give enough information to their client to be able to understand exactly what category this falls into. I do advise valuers not to start determining for themselves which of the levels that appear in IFRS 3, whether it's level 1, 2, 3, but they should give enough information in that to enable their client to make that decision, and also their client's auditor to satisfy themselves that that allocation is correct. I mean, for those who are not familiar with levels 1, 2 and 3, it doesn't indicate that a level 3 valuation is less reliable than a level 1. It drives the disclosures that are required. And almost without exception, most real estate values will go into level 3 because they're not using prices which are quoted and publicly available in a observable market, which is level 1. They often require substantial adjustment to comparable data, which means they can't go into level 2. So level 3 is the norm that virtually all company reports I've seen will categorize their real estate assets. But valuers have to provide a proper rationale for their valuation in the report and explain how they've got to their figure. That's fairly fundamental, and it's something that auditors need to be checking as well.
Okay, thank you so much, Chris. So my next question would be directed at Olamide Bajini. So how should investors, stakeholders, and other users of financial statements benefit from robust presentation and disclosures as it relates to valuation of assets in the financial statements? How would they benefit from it? Okay, I said, how would investors, stakeholders, and other users of financial statements benefit from having a robust presentation and disclosure as it relates to valuation of assets in the financial statements?
Okay, so if you look at the very basis for disclosures presentations in the financial statement. The real purpose or the main purpose of it is to protect the end users of those financial statements, which are the investors, either current or proposed investors, shareholders, government, employees, and the likes. So the importance of the qualitative characteristics of a financial statement is to show clear indication that relevant information are in those financial statements and it has been faithfully represented. And in faithfully representing the elements or the items in the financial statement, there must have been substantial compliance with the provisions of the IFRS. And if you look at the provisions of the IFRS, it's a matter of law and not just practice in Nigeria by virtue of the Financial Reporting Council Act, the Business Facilitation Act that was enacted last year that gave IFRS, superintendence over all other, accounting standards and rules that may be applicable in Nigeria, and the provisions of the Companies and Allied Matters Act. So IFRS is the foundation. And why does it tend to protect these users that we've mentioned? Most users will pick up a financial statement of an entity to make decision. And where element or item in those financial statements do not state clearly what it is, meaning that they've not been faithfully represented or the item they are not relevant, then it makes such investors to make a wrong investment decision. And from a point of law, let's leave account, from a point of law, where there are items or there are representation that has made you to make a decision which are false, then definitely it's a fraudulent representation. So, and you have an action against whoever has, giving you such representation that has made you to make an investment decision. So, investors really need to be protected. Items in the financial statement must be true, must be clear. Items in the financial statement must be presented and relevant disclosure made in line, with the IFRS. And apart from that, because IFRS is principle-based, it leaves a lot of discretion and a lot of judgment on the entity. For example, IFRS will not tell you what is asset. It will only give you a definition. And by your own judgment, you should be able to identify what will constitute an asset in your book. So because IFRS has given you that liberty, for example, Jamie was talking about the use of cost model or evaluation model or fair model. IFRS has given you the liberty to either use cost or fair value model. But that does not mean that you should use it at when suits you. For example, you are in this year and you realize that, if I use fair value model, I'm going to be able to have distributions for my shareholders. And next year you feel that, I don't need fair value again. Look at the cost. So IFRS does not permit you to do that. And when you are representing position in your financial statement, you must ensure that you faithfully represented those items in your financial statement.
Yeah, thank you so much, Olamide. I particularly like the last part where you mentioned about IFRS being highly principles-based. And this is very, very important. And that is why the standard requires a lot of disclosures. Because the truth is that if you call two companies to value the same property, the chances are more than likely that they will never give you the same value. And it doesn't mean either one of them is wrong. So it's just about the inputs. But what we say is that the difference shouldn't be too far apart if the conditions are similar. And then even in the same line, you could have two companies holding investment properties. And that is one thing robust disclosures help with. It helps with proper comparability so people can make informed decisions. You could have two companies holding investment properties, and maybe one is holding theirs for capital appreciation and to sell off, and then another is holding theirs for rental income. If you value those, I don't expect you to use the same approach to value both, because one is actively earning income from it, so it might make sense to use the income approach, whereas the other one is holding it to sell in the market. So you might want to consider maybe some adjusted market approach depending on how frequently or when the sales are expected to happen. So if I look at both financial statements and I see they are both fair value, as a user, I would want to understand what is driving the differences. And even as a potential investor, I might want to invest in the one that is actively earning income if I'm looking for an investment that will give me, immediate returns. Whereas if I'm looking for an investment that would give me a capital appreciation, I'm looking for future returns. So all these things are very important information that helps the users to make informed judgments or decisions based on the financial statements. And a lot of it is very judgmental in nature. So that is why it's very important to also include the basis of whatever valuations we've done. So my next question would be directed at Jamil. So Jamil, you're an auditor, and as you're aware, the FRC, they've released the guidelines or the time frame for ICFR starting from last year for listed companies. So an ICFR simply means your internal controls over financial reporting. So now management is required to assess their internal controls over financial reporting, and then the auditor is also required to review management's assessments and provide some opinion on how effective those controls are. So from an auditor's perspective, how can you advise businesses in Nigeria to strengthen their internal controls over financial reporting risk as it relates to valuation of tangible assets, and not just for the purpose of even reporting on the effectiveness of the internal controls, but even as a hedge to ensure that the numbers in the financial reports, are also accurate and reliable?
Oh, okay, thank you very much. This is a very big question, but considering the time I have available at my disposal, I will compress the response. Just like she said, the Securities and Exchange Commission required listed companies that in 2023, they need to comply with the guideline issue on internal control over financial reporting. They've all done it at the listed company in 2013. FRC looked at what SEC did, and they felt, oh, this thing was too good to be applied to only listed companies. All other public interest entities, entities that meet the definition of public interest entities, with the exception of some, should apply this in 2024. It may equally interest you to know that maybe some of real estate firms too may meet the definition of public interest entities. And what I'm about to say will equally apply to you. Now, but even if you do not meet, I'm sure you are working for clients that actually are public interest entities. When it comes to internal control over financial reporting, it's something that we've imported from US following the collapse of Enron in 2001 in US. In 2002, they passed a law that they call Sarbanes-Oxley Act, which mandated them to do a rigorous assessment of their financial statement, a top-down. You look at all the material items in your financial statement, you begin to look at them. What are those risks that could make those numbers not to be correct? You identify those risks across different levels, entity level risk, those risks in IT systems that are producing those numbers, and at the operational levels. Then you begin to put in place controls to mitigate, to prevent those risks from crystallizing. Now, this has been related to valuation, right? For an entity that doesn't have any item in its financial statement that is either measured at fair value, or even when you don't have, so that may not apply, but you may even have items that are not measured at fair value, but you have to disclose the fair value. So you need to identify all those what can go wrong, those risks that could prevent either the numbers, the valuation you have done from being correct, or those ones that you have disclosed, those risks that can prevent them, and put in place controls to prevent or to detect and correct. Internal controls are meant to either prevent the risk from occurring or to detect if it occurs. And when you detect it, you should be able to have a mechanism to correct it. Now, like I've said, if you pick investment property, an entity that has investment property in its book, the risk is there that that value that is recognized in the financial statement may not be correct, right? That is the risk. So that entity needs to put in place those controls that will ensure that those numbers are correct. Now, considering the fact that those valuations will not be done by the entity themselves, they will come to valuation experts like you to do for them. So the controls they are going to put in place may even go to the point of how do you even select the valuation expert you are using? Because the risk is that you may select a valuation expert that will give you what you want. So they want to look at all the controls you put in place to ensure that at the end of the day, that number we are seeing in the financial statement, they are correct. Also, there are some items. I mentioned investment property. If you use cost model, you don't need to, the value you are recognizing in the financial statement doesn't need to be fair value, it has to be cost. If you have a land you've bought in Ikoyi, and it's an investment property, you are holding it for capital appreciation, and you are using cost model, you don't need to fair value it for inclusion in the financial statement, but you need to disclose the fair value. That means you still need the valuer to help you determine that value. But again, that value you are disclosing, we need to be sure they are in line with the requirements of IFRS 13. So those internal control over financial reporting is actually a process that is very big. Companies other than listed that have to do it, they have to comply in this year. And the implication is that at the end of the year, management of the entity will issue a specific report where they will conclude that our internal control over financial reporting is effective or is not effective. And the guideline issued by FRC says, if you have at least one material weakness, you cannot conclude that your internal control is over financial reporting. There's a difference between deficiency, significant deficiency, and material weakness. It is that material weakness. Once you have one or more, at the end of the day, you must conclude that it's not effective. The auditor is equally meant to issue a separate report, different from the report we've been issuing before now, where we are equally going to assess, or either we agree or we disagree with the assessment that has been done by management as to whether the internal control is effective or not. Thank you very much.
Thank you. Let me just ask a little follow-on question based on something you said. When the valuation experts produce their reports and give to management, do you think it's best practice for management to just take the reports and give to the auditor, and when the auditor asks any question, they'll say, is what the expert said? Or should management challenge? Should they be a part of that process, understand the inputs, and also make their own suggestions? What do you think?
Thank you very much. Financial reporting is going to an extent that even companies that are engaging external valuer, you need to take ownership of the process, right? And taking ownership of the process means internally. You need to have somebody that has the knowledge so that when that report is received from that external valuer, you can review and challenge. You can look at whether all those things that are meant to be there are there. You can throw it back at whoever has done that valuation, such that when the auditor comes at the end of the day, the amount of questions and queries can be limited.
Yes, in fact, you'll be able to engage the auditor. They may not even need to speak to the specialist because you've understood it so much, you owned it, and you can defend it. Because if anything happens, it's the company they will hold first. Okay, thank you so much. My next question is directed at Chris. So Chris, on the back of that, following on in the spirit of that, what should auditors look for what should auditors look out for when reviewing valuations presented in the accounts?
Well, I think we've heard quite a bit about that. In my session this morning, I talked about examples of where I had been called in by the financial regulator to look at valuation reports of investment property, and they've been signed off as compliant with standards by the auditors, and clearly they didn't comply with the standards, which was a question I was being asked. But I mean, that just, I think, tells me that there is a big disparity amongst the audit firms globally on their knowledge and expertise in what to look for in valuations in the companies they're auditing. I was very pleased to hear the comment about the previous comment about the Nigerian equivalent of Sarbanes-Oxley and the need for there to be controls in place. And I mean, that's mirrored in other places. In the UK, where I am, the financial regulator, certainly for investment investment companies, investment property companies, let's call them that, expects to see non-exec directors involved in the appointment and review of valuations, so there's sort of controls in all sorts of countries which are aimed at achieving this greater consistency and avoiding mistakes taking place. But I think what the auditors need to be looking for is, when they get hold of a valuer's report, is that it does contain sufficient reasoning for the valuation figures which are reported, to enable them to then compare it with the requirements in IFRS 13 as regards identifying the inputs that have been used, and any conditions that apply to that valuation. And as Ben Elder said this morning, a good valuation report should tell a story. And you know, if they can't follow that story and it comes to a conclusion that is not logical with the rest of the report, then the auditors really need to challenge it. But I mean, it is a big issue globally, because for the last dozen or more years, ever since the Organisation of International Audit Regulators, IFIR, have been issuing annual reports, every year, top of their list of audit referrals have been fair value estimates. So, you know, globally there is a big problem here in the degree of challenge that is being made to fair value estimates which are appearing in accounts.
Okay, thank you so much, Chris. So my final question, I would like to direct this at both Olamide, and after that I'd also like Jamil to also share his perspective on this. We've talked about the subjective nature and the judgmental nature of valuations, and the extensive disclosures required. And where you have such standards or such areas, you cannot overemphasize, you know, the relevance of the regulators in ensuring not just compliance within the industry, but also fair presentation, going even over and above the compliance to what would actually benefit the industry and safeguard, you know, the stakeholders in the business. So my question is this: what are some of the steps that regulatory bodies like the FRC, SCC, and NIESV can take to provide effective oversight with respect to financial reporting and valuation?
So for me, I think these regulatory authorities, they have enough powers already, because a lot of entities are already complaining on some of the regulatory releases from time to time, the requirement to comply with it. I think for now, for me, I think the regulatory framework and the powers they have now is enough. What I believe they should do for now is to ensure that companies comply with the requirements of reporting, and effective, efficient, and faithful reporting. And two, these regulatory bodies should, from time to time, meet with relevant entities and stakeholders within the industry to intimate them on what they expect to have discussions with them on their expectations and the things that they should be doing. For me, giving more powers, I think the powers they have for now, it's okay. Thank you.
Okay, Jami.
Okay, thank you very much. I will look at it from two perspectives. The first one is, I believe you cannot give what you don't have, right? What that means is that all stakeholders, regulators, those who are involved in financial reporting value chain, the auditors, the valuation experts, all of them need to be aware first the key requirements about what the standard says. We are talking of financial reporting here, what the standard says. So there should be seminars, there should be awareness. This will be the first of this event that we attend. Perhaps, maybe DF Party Millennium and Business Day, you've been collaborating and doing something like this before now. So I believe this session is good and we need more of this. I think on the part of the regulators as well, they need to do more, create more awareness. I think a long time ago, FRC they brought us together, and I suggested that some of their directorates need to be active. They need to be up and doing. And they need to bring all of us together, especially the valuation experts, the auditors, the financial reporting experts, so that we can talk, brainstorm, and be able to reach a point that we believe that what is being done is acceptable to all. So I think we need to do more of what we are doing today. Secondly, I'm happy that FRC has power. Other regulators have power as well. The FRC Act was enacted in 2011 to replace the then Nigerian Accounting Standard Board Act. And since that time, we've always had a directorate of valuation there. But not until recently, maybe this year or last year, this year, that they are making that to be active. And I believe the existence of that will really go a long way to help. For us as accountants, as auditor, we are regulated by our professional body on one hand, which is ICANN, and we are regulated by Financial Reporting Council on the other hand. For valuation experts, as long as you have input in financial reporting, you can be a valuation expert without having impact in financial reporting because you have not done any valuation that is meant to be used for financial reporting. But if you have done a valuation that is meant to be used for financial reporting, not only real estate valuers, there are some other valuers we are not talking about today because the focus here is tangible assets. We equally have intangible assets. We also have unquoted equity,
Actuaries.
unquoted bonds, actuaries. I think I'm happy that FRC is doing a lot, trying to collaborate with relevant, similar valuation standard setters elsewhere in the world. I believe doing this, being active, and ensuring that all those regulators, they have the people who can really ensure that they are able to spot companies that are not doing the right thing. I believe that will really go a long way to help. Thank you.
Very, very insightful. Thank you.
If I may just quickly add, when you were talking about the regulators, you didn't mention FRS. FRS too is also a significant regulator in this aspect. And I remembered where Nigeria introduced IFRS. IFRS came up with a circular on tax implication of IFRS adoption in Nigeria. And in relation to assets that we are talking about and report of valuers, one key thing from that adoption is that professional fees paid to valuer is not an allowable expense according to the IFRS. So maybe the valuers should know that when you are collecting.
You need to advocate for that.
So that's one. Then two, when the IFRS was adopted, it syncs with IFRS position synced with the IFRS position, in the sense that all exchange gains and all exchange loss should go to the profit or loss account. But just last week, IFRS released a circular on impacts on the foreign exchange transaction. And they are saying that when there is a foreign exchange loss, it should be capitalized as part of the asset for the purpose of capital allowance. When there is an exchange gain, it should be realized as a gains and liable to capital gains tax. I just thought to give that update. Thank you.
Okay, thank you very much. We'll be sure to consider that in our tax assessments. Okay, and with that, my time is up, and I would like to thank my wonderful panel, and I'll hand over to...
Thank you very much. Thank you very much. We can do better. Our clapping should be raised to the power of 4 again. In fact, 4 plus, because we have one of our panelists online. Thank you very much. Thank you very much. I'd like again to say thank you to our panelists. Mr. Christon, thank you very much. Mr. Jamiu Olakison and Mr. Olamide Obajimi, thank you very much. And to our moderator also, Miss Uloma Ojima, thank you very much. So we'll take our questions now very quickly. I'm sure we have questions. Yes, I see one hand up there. Any other question? If we have questions online, please send them to me. Okay, so let's take the first question from the lady on my right.
Good afternoon to all of the panelists. My name is Eniola Olatunji.
Please speak up.
So my name is Eniola Olatunji. I'm a journalist with Business Day. So my question is not exactly on reporting standards, but of recent, we saw a particular company revalue their plants, and they revalued their PPE, and that brought at least their assets up significantly, which would in effect affect shareholders' fund. So I wanted to ask, on what basis do companies get to revalue their assets? Like, so if, for example, if a company makes a loss, can they just decide to revalue their assets so as to ramp up, yes, next time? Or like, what exactly is the basis for like revaluation of one's assets? That's my question. Thank you.
Thank you very much. Yes.
Okay. Although you said the question has nothing to do with financial reporting, if I heard you correctly, but it's a financial reporting related question. Like I said earlier on, if you have property, plant, and equipment, we have what we call classes, right? Land is a class. Building is a class. Motor vehicle is a class. Computer equipment is a class. So the decision to either revalue periodically or maintain cost, less accumulated depreciation, has to be made at a class level. Meaning that if you say land, you want to revalue land, then all land that you have has to be revalued. If you say building, you want to use revaluation model, you have to be revaluing all of them periodically. If you say it's plant and machinery, you have to be revaluing all of them periodically. In this part of the world, I'm not saying it's not, it doesn't exist. Oftentimes, when it comes to revaluation model, companies have used it mainly for land and for building. The standard doesn't say you cannot use it for other types of property, plant, and equipment, but companies hardly use it. Now, for the company that you said that did a revaluation of building, of its asset, I assume it's either land or building or both of them together, or all. Okay, it's allowed, like I said, for you, but if that is the first time that company is doing it, right? That means previously the company possibly was using cost model. And the company has decided at that point in time to do revaluation. It's allowed. In that year, that company needs to do extensive disclosure. For instance, you need to clearly state that your accounting policy has changed from what it used to be, which is cost model for all these different classes, to now revaluation model. Then it means going forward, right? You have to be doing it as frequent as possible, which I mentioned earlier that the standard said, for example, between 3 and 5 years, you need to be revaluing it. So that company has to do it going forward and incur the cost of doing the valuation, right? Secondly, that company cannot wake up and say, oh, I'm not, the standard doesn't expressly prohibit it, but it indirectly prohibits it. That you now wake up 2 years along the line and say you want to go back to cost model. The revaluation model you've changed to is considered to be better than that cost model. So you need to keep to it. So in another year when you revalue and it gives you a loss, then you have to equally take it. But the implication of that is when you do a revaluation and it gives you a loss, if it gives you a gain, like I said then, it doesn't go to your income statement. It doesn't affect your profit. It goes to, through a statement called other comprehensive income. From there, it goes to revaluation reserve. So it boosts your shareholders' fund. If you revalue again, that same property, if you revalue again, if it gives you a loss, that loss will not go to your P or L. It will not go to your income statement. It will go through that same OCI to that revaluation reserve until it reduces it to 0. If the revaluation surplus you have there before is 100 million, but when you revalue this year, you have a loss of 180 million. So 100 out of that 180, we go to reduce that revaluation reserve to 0. The balance of 80 million now will reduce your profit for the year. So that company must have done the assessment of whatever it has embarked on very well, such that going forward, it needs to live with the implication.
Thank you. Beautiful. That was a very detailed answer. Thank you very much, Mr. Jamiu Olakison. We'll take one more question, if there is. Yes, madam. Okay. So it's the ladies asking the question in this session. That's nice. Please go ahead.
Okay, good afternoon, everyone.
Good afternoon.
My name is Loveland from Nova Bank. Okay, my question is, normally we do 3 years evaluation reports. Most cases, the purpose is to finance someone. So you made mention, Olamide made mention of there are reasons why you can do it every time, like regularly. I want to know, for example, if the bank says 3 years, or maybe 3 to 5 years, what should I be looking out for to say, okay, for this person, it has to be annually or maintain it? How do you watch it as a bank?
So are you talking about revaluation?
Yes.
For the bank or for the customer?
For the bank. What do we look out when we're demanding for that? Like for every customer, if for instance the bank standard says 3 years before you revalue, with what you just mentioned, is there in any case that we can say, okay, for this very customer, because of one thing that you might let me know now, that we should do it annually or maintain what the standard says, no matter what the customer.
So except you suspect probably there is the asset in that particular industry which that customer is suffers impairment from time to time, you may feel that the value that they've recognized or disclosed in their books is not the real value of that asset. Probably it has suffered impairment, probably due to technological advancement, or you think the area has been designated in a particular manner by the government such that the value of the property there is no longer valuable. You may just tell the guy, you know what, the value of your property last year cannot be this year because of this, and that. And as such, you must do an impairment review. And for you to do an impairment, you must value the asset. Because what IAS 36 says is that if the carrying value of an asset is more than the recoverable amount, then you must, reduce that value of the asset by the lower of by the recoverable amount, and the recoverable amount is the lower of fair value, the lower of the fair value of that asset,
and value in use. And value in use. And the value in use is the value that the entity will derive from the continuous use of that asset of the time that it disposes it, or it's no longer going to use it. So if the bank is of the opinion that, see, this your asset has been impaired, go and value it so that we can know the real value of that asset, then yes, the bank may say, you know what, value. But the bank, I'm not sure the bank would think the value of an asset is more and tell you to go and revalue it, because it's not in their interest to do so. I hope I've been able to answer your question.
All right, thank you. I think you do.
All right. Thank you very much. And with that, is there any question online? In the absence of any question online, I think with that, we've come to the end of this session. Thank you very much once again to our wonderful panelists, Mr. Christon, Mr. Jamiu Olakison, Mr. Olamide Obajimi, and Ms. Uloma Ojima, our very able and articulate moderator. I want to call on please don't leave. I want to call on Mr. Odunayo Ojo to please come up and also join them to take some photographs. I'll also call on the founding partner of Dear Fatimile & Co. in the person of Mr. Boyega Fatimile. Sir, please come up. The partner of Dear Fatimile & Co., Mr. Ido Bakari, please come up to take pictures. And the representative of the chairman of the Redan, sir, please come up to take pictures. If we still have Mr. Silvanos Enenche, please come up. We'll just take quick pictures, and then we'll go into the last session for this afternoon. Thank you very much. The panelists, please. Thank you. Let me also call on Mr. Boniface Waweru from RICS. Mr. Boniface Waweru, please. Thank you. Thank you very much. Thank you very much. I hope you had nice smiles for the camera. Thank you very much. Thank you, sirs. Thank you. So we're moving into the last part, more or less, of today's event. We're gradually coming towards the end of the program. I'd like to thank us all again for our patience since morning, since we started off in the morning. But I'm sure you agree with me that it has been time well spent. So to take us through the last session for this seminar today, I'll be calling on Mr. Boniface Waweru. Mr. Boniface Waweru is the director partner of the RICS here in Nigeria, I believe. And he's going to be giving us an address from the RICS in just the next couple of minutes. Thank you very much. Can we appreciate Mr. Boniface Waweru? Thank you very much.
Thank you very much. My name is Boniface Waweru. I am a Partner Development and Public Affairs Manager at the Royal Institution of Chartered Surveyors. I support Sub-Saharan Africa. That means East Africa, West Africa, and Southern Africa, except South Africa. And I'm based in Kenya. So my first time in Lagos State. Very nice. Yeah. Thank you for having me. I'm a chartered valuation surveyor. I'm also a registered valuer. I'm a registered estate agent, and I'm a member of the Institution of Surveyors of Kenya. So I will not do a lot of difficult talk today because I'm here to talk about RICS. And in RICS, we deliver confidence. Yes, so our work in collaboration with others provides a foundation for confident markets. So we deliver confidence in the markets that we operate in. And we mostly operate in, so some of the benefits for being a member of RICS is professional status, recognition, market advantage, and knowledge network. So some benefits for your organization, for your company, would be to attract and retain talented people, a professional project delivery, also deliver added value as well as optimized costs and minimize costs and the risk to your client and the projects. So we encourage individuals, if you are a surveyor in any of the 22 disciplines that we have, that you become our member. Our global presence is growing. We are at 134,000, and this number has increased actually. And as you can see, we are all over the world, and we operate in the main areas of land, construction and infrastructure, and property. Our priority areas are urbanization and infrastructure, sustainability, and in the area of sustainability we have a new, we're calling it the whole life carbon assessment standard. We have a new standard, and we'll talk a bit about that. We are also in data and technology, diversity, equity and inclusion, ESG, and next generation. So for the diversity, equity and inclusion, we are mostly encouraging women to join, to become surveyors, and to continue being surveyors so that they do not drop off at some point in their careers because maybe of getting children and things like that. And for next generation, we are mostly talking to university students who are taking surveying courses to encourage them to that they're in the right career path. And so we, as I've mentioned, we have professional standards, and I'm happy that today we are talking about standards. So I'll talk a little bit about the standards that we have, and the reason why we are big on standards. Maybe how I like to, I'll read it, and then because of globalization, market efficiency requires market consistency, transparency, and comparability. International standards are the backbone. So previously when I worked as a valuer, I did a valuation of a property here in Lagos, but it was during COVID, so someone else helped me to do the inspection, so I didn't come in person. But the fact that I could do a valuation from Kenya for a property in Nigeria, I've done for properties, I've done valuations in six African countries. It means that we have become a global, globalization is there. So we are, the world has become a global village. So it is important that we adopt and continue upholding international standards. Yeah, and also another way to look at international standards, and if you're still not convinced, the way football is played here in Nigeria is the same way it's played in Kenya, it's the same way it's played in other countries. So because the FIFA has a standard, and this is a kind of standard that we like to uphold for surveyors globally. So a lot has been spoken about standards today, financial reporting standards, international valuation standards. So there are more standards. There's international land measurement, international construction, property measurement standards, international valuation standards, but all of them, international financial reporting standards, all of them must be done in an ethical environment. Also, on the issue of thought leadership, RSCS is big on thought leadership, and we are big on sustainability and decarbonization. And as I had mentioned, that we have the whole life carbon assessment for the built environment. This is our latest standard, the second edition, and we are promoting it across the world. And the reason we are doing that is because it is set to become the world's leading standard for consistent and accurate carbon measurement in the built environment. And it's the only comprehensive standard providing a whole life carbon methodology for projects, assets, allowing professionals to use it alongside their national and regional frameworks. I would want to encourage us to go to the RICS website and download it and read it and see how you can apply it in the market that here in Nigeria and in the other markets that you that you operate in. So also on thought leadership, we have our World Built Environment Forum, and we have where we address global megatrends, forums, research, conferences. So there's quite a lot. I would like to also just in passing mention the different types of membership applications that we have. Mostly we have two, associate member and chartered member. Associate is where you have 1 year of experience after university, and chartered is where you have more than 5 years of experience. The chairman of the Estate Surveyors and Valuers Registration Board of Nigeria was here. Then we are having a discussion about having a direct entry agreement between SVABON and RICS. But even as those conversations continue, I'd like to encourage you, if you're here and you're not a member of RICS, that you look at our website and see how you can become our member. So we also have a network for for once you become our member, so mostly for networking and support for newly qualified members and trainees. And this, the purpose is mostly to provide networking and business contacts, ensure development and promotion and growth of RICS. We also have jobs globally. So we have more than 1,000 vacancies across 30 different specializations on Recruit. So I'd like to encourage you to also have a look at our website, Recruit, if you are looking for a job in the more than 140 countries in which RICS has members. And the jobs are both for associate members and also members, full members of RICS. We also have a graduate hub. So if you're looking for graduate level jobs, you're welcome to look at that. We have trainings, and we are big on trainings, and I would like to encourage you to also look at the trainings that we offer. Some of them are face-to-face. We also have blended online and knowledge and competency bundles. This is where you can specify that we would want to be trained in a certain area. So we are very big on this, and we customize it so that it is relevant for your market. And we also have RICS dispute resolution. So in case you would like to learn more about alternative dispute resolution and have a certificate in the same and as with a specialization in the construction industry, in real estate, then this RICS Recruit, then we encourage you to look at our dispute resolution DRS. So we have skills. If you want to upskill and add credentials to your CV, you can become a RICS accredited mediator, an expert. We also have expert witness certificate, expert determination, diploma in adjudication, diploma in arbitration, diploma in international arbitration, and most of these foundation certificate in ADR and conflict avoidance, and most of these are offered online. So what I would like to mention is that in case you would want to do, or your company would like to do, we can have a conversation about giving you a discount, a quantity discount, and seeing how we can support you through that. Yeah, so thank you very much, and thank you for having me. Have a good afternoon.
Thank you very much. Thank you very much, Asante Sana, Mr. Boniface Waweru. We can do better than that. Are we forgetting our agreement? You've done very well so far. Now that we're getting to the end, we must keep the performance up. Thank you very much, Mr. Boniface Waweru. I hope you do enjoy your time here. We say Karibu Sana to you in Lagos, and we wish you a safe journey back as you go back to Kenya. All right, we're gradually moving towards the end. In fact, we've come to the end of this seminar this afternoon. But before I call on the gentleman that will take the closing message, again, I'd like to say a big thank you to our sponsors for today, EcoBank, FMDQ, and Nova Bank. We appreciate you. Thank you so much. I'd also like to appreciate some special people whose support has also made today a great success. I'd like to say, on behalf of the organizers, Dear Fatimilei & Co., Business Day, and RICS, we'd like to say a big thank you to Dr. Mojisola Fatimilei, the wife of the founding partner of Dear Fatimilei & Co. Please let's give her a round of applause. Thank you, Ma. Thank you for always being there. Thank you for your support at all times. We'd also like to appreciate the partner of Dear Fatimilei & Co., Mr. Ido Bakari. Mr. Bakari, thank you. Thank you so much. Thank you also for always being there. And to the management and staff of Dear Fatimilei & Co. and Business Day, thank you so much. All right, so I'd like to thank us too, our participants. You've been wonderful. Please clap for yourselves. You've been here since morning. Thank you very much. And to our participants online as well, you are not left out. We appreciate you. Thank you very much. To give the closing address or the closing message, it's my pleasure to call on Mr. Lanre Olutimilei. Mr. Lanre Olutimilei is the strategic advisor for Dear Fatimilei & Co. and very key in putting together today's program. So please let's appreciate him. Let's appreciate him as we welcome him to the podium to give the closing message. And after the closing message, please lunch is served. So please make sure to have your lunch before you take your leave. Thank you very much.
Good afternoon, everyone. It's been a long day, but we've come to the close, and I'm sure that you've all found it very useful. So I was going to give some vote of thanks, but our MC has run ahead of me a little, but it's okay. I will do it again. You can never be too thankful. So on behalf of Dear Fatimilei & Company, I would like to thank Business Day once again for their valued partnership. It's been very instrumental in getting this event put together. Thank you. I would also like to thank the RICS and Mr. Boniface Waweru for coming from Kenya to attend. The support of the RICS has been very invaluable. We heard from Mr. Benelda, the Global Director of the RICS, and it was Mr. Benelda who introduced us to Mr. Chris Thorne of Valuology, who is also a fellow of the RICS. So that was very, very interesting. Their insights were very, very helpful. We'd like to thank the Financial Reporting Council of Nigeria as well as the Director of the Valuation Directorate for attending and for delivering the address earlier today. We want to thank the regulator, ESVABON, and the chairman and the registrar, I believe, who attended as well. A big thank you to all our speakers, Mr. Chris Thorne, Mr. Benelda, Mr. Odunayo Ojo, Mr. Silvanos Eneche, Mr. Jamiyo Olakison, Ms. Uloma Ojinma, Mr. Olamide Obajimi. I think their insights were very invaluable, and I think, we were very engaged. I'm glad to see everyone so engaged. Please, a round of applause for them. I want to thank the audience, everyone in here, and those online. Thank you for making the time, and thank you for the commitment and interest. Thank you. The organizing teams from Dear Fatimilei and Business Day, the work they've put into this, behind the scenes and the hours, it's been quite a bit. They've made a lot of effort to get this across the line. So a big thank you to them. Please, a round of applause for them. The reward is that round of applause because they're going to be doing it again soon, I'm sure. Thank you. Once again, I will also thank the founding partner of Dear Fatimilei & Company, Mr. Fatimilei, the partner, Mr. Bakare, and the publisher of Business Day, Mr. Aigbogun, without whose commitments this would not be possible. Thank you. Most importantly, I'm going to thank God, who has given us the grace and the provision to make all of this possible. So please, your biggest round of applause for Almighty God. So I hope we've been able to communicate today. I think what we wanted to do was to deepen the understanding of the valuation standards and how they relate to financial reporting. I think we have achieved this today. I think everyone has a very good understanding and everyone is going away with a few things. So just a few takeaways before we go to lunch. One of the things I learned was that valuation should tell a story. And those standards, these standards we've been talking about, guide us in helping to tell that story. And the user should be able to understand what we are producing as well as valuers. Disclosure, disclosure, disclosure. I think we've heard that quite a bit today. Rationale, rationale, rationale. You know, why are we saying the things we are saying? That's very important. And also, we've learned that inappropriate valuations lead to risk. And it's something that we have to look out for. So once again, I want to thank you all. And I wish you all a safe journey back to your respective destinations. Thank you.
Thank you very much, Mr. Olutimlei. Thank you very much. Thank you very much, our distinguished participants and audience. So lunch is served in just the room behind us, the adjoining room where we had our tea break. Let's just move over there now and enjoy your lunch. Thank you very much and safe journey back to your destinations. Good afternoon.